Hello and welcome to Session 18 of the Basic Tax course. We're going to begin Session 18 with a review of the Session 15-16 Quiz Answer Key. And taking a look at the most frequently missed questions from our quiz on depreciation, we begin with question number 5. Assuming you are not claiming bonus depreciation, the maximum depreciation deduction you can claim on a passenger automobile for 2011 is $3,060. However, if you claimed a Section 179 deduction, the maximum depreciation will be more. The correct answer for that is false. The limit on automobiles applies whether you claim makers, double declining balance depreciation, straight line depreciation, or the Section 179 deduction. That maximum limit in the first year continues to apply. There is an exception. If in the first year you claim bonus depreciation, you are allowed an additional $8,000 of depreciation. But in this problem, we specifically tell you we didn't take bonus, and therefore that additional $8,000 increase does not apply. And bear in mind, of course, that if you are claiming a Section 179 deduction, the deduction is limited to a maximum of $3,060 in the first year. But on top of that, the deduction may actually be less than that because, of course, you would need to multiply $3,060 by the business use percentage and use the lesser number if the percentage is less than 100%. And the next question that we're going to look at is question number 11. Real property includes which of the following? Your home, your car, a photocopier that you use in your business, your home computer, or E, all of the above? Well, real property means real estate, and the only piece of real estate offered as an option is your home. Yes, your home is real property. Real property includes land and anything built on land. And the next question is question 14. Maker's 200% declining balance applies to 3, 5, and 7-year property not held for farming only. And the answer is not 3, 5, and 7 only, but also 10-year property. So this is a false statement because it omitted 10-year property. Question 16. You can claim a Section 179 deduction for the cost of a dishwasher you install in your residential rental property. That's a big fat false. The Section 179 deduction is never allowed on property that is held for rent or lease to others. So you cannot claim a Section 179 deduction on a dishwasher placed in service in your rental property because that would mean that it is property being held for rent to others, and property held for rent for others cannot have a Section 179 deduction claimed upon it. Question number 17. You can claim a Section 179 deduction for the business use portion of the value of your car, subject to the limits on passenger automobiles, if the business use percentage on your car is 50% or more. And that's a false. Now we're getting pretty picky here, but this is the difference between being limited and not limited on listed property. In order to claim a Section 179 deduction on listed property, the property must be used more than 50% in business, and 50% or more is not the same as more than 50. So the IRS is very clear that it has to be more than half or more than 50% business use before listed property is eligible for a Section 179 deduction. And of course, any listed property that is not more than 50% business use is also not eligible for maker's accelerated depreciation and must instead be depreciated straight line ADS. Question number 21. In 2011, you sold a desk which you previously elected to claim a Section 179 deduction on. You figure your recapture amount by, and it offers you 3 different options. Well, option number C is the correct option. You figure the amount of gain realized upon disposition of the asset that is due to previously allowed or allowable depreciation, the Section 179 deduction or special depreciation allowance, and then reporting this amount as ordinary income. So essentially, when you claim depreciation on an asset, that depreciation reduces your basis. And to the extent that you have a sale that results in a profit, and that profit is due to recovery or recapture of that basis, you're going to have ordinary gain. So in 2001, you sold a desk for which you previously elected to claim a Section 179 deduction. You figure your recapture amount by figuring the amount of gain that you have and reporting it as ordinary income. Number C. And of course, the sale is reported on Form 4797 and on Form 1040, line 14, as ordinary income. And here is our mini problem. Our depreciation mini problem. Joe's heating and air conditioning is a home-based business. Business profits prior to any deductions for depreciation totaled $50,000. Joe purchased and placed in service the following assets for the year, and they include a February purchase of a laptop computer with a cost of $1,200 and a business use of 100%. It also includes a generator, which is considered to be 7-year property, a cost of $800 and business use percentage is 100, and then in July a Dodge Caravan weighing 5,000 pounds and costing $25,000 was placed in service and it's 85% business use. The maximum auto depreciation in 2011 is $3,060. Do not claim the special bonus depreciation on any asset. Joe would like to depreciate the generator and the van, and he would like to expense the computer. And using the tables provided, complete Form 4562 and then answer the questions, rounding your answers to the nearest dollar. And of course, we have a maker's table here showing the amount of depreciation claimed on 5-year property where the half-year convention applies, and actually the mid-quarter convention as well. But for these assets, we will be applying the half-year convention. And then we also have a table for 7-year property. So looking at the assets placed in service, we have a laptop and a Dodge Caravan, which are both 5-year property, and we have a generator, which is 7-year property. So therefore, we're going to use the first table for the laptop and the auto, and we're going to use the 7-year table for the generator. Let's take a look at the answer key. And here we have Form 4562 as completed for the Session 1615 quiz assignment. And you will see that the first part of the form that is completed is the election to expense under Section 179. Line 1 is a predetermined number. A maximum threshold amount is $500,000. Our job is to enter on line 2 the total cost of Section 179 property placed in service for the year. And we show you how we figured that at the top of this answer key. And here we have the van at 85% business use and a cost of $25,000. That gives us a Section 179 eligible cost of $21,250. The laptop and the generator are listed at full price because they're both 100% business use. And when you add up those three numbers, you get $23,250, which is, of course, the number that we enter on line 2. Then on line 7, we enter listed property from the earlier page. And obviously, we have two pieces of listed property. We have the laptop and we have the automobile, the Dodge Caravan. And so we go to Part 5 of Form 4562, and on line 26, for property used more than 50% in a trade or business, we list the computer and the Dodge Caravan, the percentage business use, the date placed in service, the cost of the property, and then the basis for depreciation is the cost multiplied by the business use percentage. We then enter the recovery period, which on the van is 5 years, but there's no recovery period listed for the computer because we are claiming a Section 179 deduction on the computer, and we are entering $1,200 as the elected Section 179 cost on the computer. The depreciation deduction on the van is $3,060 multiplied by 85%. That gives us $2,601, and that is the total in column H of line 26. That number carries down to line 28. And both numbers respectively will carry over to page 1. And on page 1, we list the Section 179 deduction for the laptop computer. And down on line 21, we enter the amount of depreciation claimed on listed property from line 28. This is the minivan. And then we enter on line 19 the amount of depreciation being claimed on the generator. The generator has a cost of $800. It is 7-year property falling under a half-year convention with 200% declining balance, and the first-year depreciation deduction is $114. We add $1,200, $114, and $2,601, and that leaves line 22 being $3,915. So that concludes the review of the Session 1516 quiz answer key. Let's take a look at the Session 17 homework assignment and Miss Diana Prince. Revisiting the homework assignment itself, we have an ask in here for you to prepare the following forms, which include 1040, Schedule A, Schedule D, Schedule E, 4797, the Schedule D tax worksheet, the unrecaptured Section 1250 gain worksheet, and our character is Diana Prince. She sold her rental house to Steve Trevor. The house was vacant, but it did have some expenses, and the expenses were property taxes of $500, mortgage interest of $4,000, utilities of $500. Diana originally purchased the rental house on January 15, 2002 for $98,000, and at that time the land value was $17,000. She did not live in the home at any time, and she had the following costs on the purchase of the property that have been added to the basis, and they include title charges, other closing costs, and points paid on purchase. Now, over the years, Diana made the following improvements to the property. She installed a new roof, she remodeled the kitchen, she made repairs, she purchased a new refrigerator, new carpet, and a new fence. And she has assigned a portion of the value of the proceeds to each of these assets. And so the house, we're going to be asking you to allocate this portion of the sales proceeds, which were $180,000, to the house, and $30,000 will be allocated to the land. The refrigerator, you will allocate $200, and so forth. And then Diana incurred the following expenses in relation to the sale of the property, including fixing up expenses that were paid within 6 months of the sale of $1,400, real estate commissions in the amount of $10,900, and closing costs in the amount of $1,800. Now, there is a copy of Diana's depreciation schedule here. And the importance of the depreciation schedule is, of course, you're going to use numbers that appear on this schedule for completing Form 4797 and figuring the amount of gain. Let's take a look at the answer key for Diana Prince. And here we have the Session 17 homework answer key. Now, this rental property is a business use asset. So when Diana sells this business use asset, and it is an asset that has been subjected to depreciation over time, the sale is going to get reported on Form 4797. There is a point for discussion here. Should the sale of the house and its individual improvements be treated as a single sale on Form 4797, or should the sales price be broken down and allocated to the house and each improvement separately? You might be wondering why we made it difficult by breaking it down into each sale separately. And there's a reason for that. The reason is that over time, when you are preparing tax returns on computer software, that software is asking you to make line entries for each asset as it is placed in service. And over time, the placed in service date of an asset and the amount of depreciation being claimed on that asset, of course, has to be tracked. Now, when it comes time to sell an asset, different software will handle sales in different ways. But ultimately, at some point, the software is asked to combine sales amount with cost basis and prior depreciation amounts that are already in the system. And it may be possible in a particular computer software to lump everything into one category and have a lump sale, or it may be that the software wants you to divide things out. For point and purpose, or at least for point of discussion on the software that we're using, the method we've chosen is to break the amounts out. It makes it more clear in terms of how to fill out the Form 4797, but it does make it necessary to allocate the amount of the sale towards each asset that is on the depreciation schedule. And that simply allows the software to take each asset that is on the depreciation schedule and turn it into a sold item. So that's why we've chosen it to do it that way. Now, is it appropriate or inappropriate to do that? Well, that's a question I had for a while. As I looked at Diana Prince over time, over the last 11 years that I've been teaching the basic tax course, I had more than one student ask me, well, is it correct to break it up or should you lump it together? And I scratched my head. I wasn't really sure. It seemed to be the case that you were supposed to break it up since that's the way our software was encouraging us to do it. But then again, it made perfect sense to lump it all together and have a single sale. So which way to go? So I called an IRS auditor that I knew here with the IRS here in Portland, Oregon, and talked with him about it. And his response was that the IRS actually doesn't care how you do it. What they care about is that the sale and the completion of Form 4797 is an accurate reflection of the gain or loss, and that splitting the assets or lumping the assets, either way, does not cause there to be a misreporting of the amount of gain on the sale. So ultimately, the important part is to make sure that you're reporting the correct amount of ordinary gain, the correct amount of capital gain, and that you're not somehow using the form to skew those numbers. So in Diana Prince, we've given numbers that we felt were fair market valuations of a particular asset. Diana has sold one asset that is all of those assets combined, and we've divided the sale accordingly. So let's begin at the top of Diana Prince's tax return. Obviously, she is a single filer. She has a W-2 for $90,000. And we have some capital gains coming over to line 13 and other gain and loss items. Well, let's begin with the capital gain line, line 13, and see how we did those calculations. And really the place that we start with those is the Form 4797. And here we have Diana's Form 4797. Now, if we look at the assets that were sold, we can see here that she sold house, land, refrigerator, a new roof, a remodeled kitchen, new carpet, and new fence. And in Part 1, we report assets that are sold at a gain or a loss, and no recapture of depreciation or recovery of depreciation is going on. And so the land, although it's sold at a gain, there's no recovery of depreciation that is occurring with it because you can't claim depreciation on the land. So on the land, we were going to report that sales price of $30,000, which we provide you in the wording of the problem. And we'll compare that to the $17,000 purchase price that we told you was the fair market value of the land on the date that Diana purchased. We also have entered the sales of the roof, the remodeled kitchen, and the new fence. All of those assets are depreciable assets, but they're being sold at a loss. So on each asset, we show the sales price, we show the cost, and we show the depreciation allowed or allowable for that asset. And here we have the new roof. It has a cost of $5,000. We show that the prior depreciation deduction that has been claimed on the roof is $660, and that the 2011 depreciation is $53. So $660 plus $53 is the $713 of depreciation allowed or allowable since acquisition. Next, we have the remodeled kitchen, and we can see that line 4 on the depreciation schedule. The remodeled kitchen also has a cost of $5,000. The placed in service date is August of 2007 rather than May. And prior depreciation on the remodeled kitchen is $614, and current depreciation is $53. You add $614 and $53, and you get $667. That's the depreciation that has been allowed. And then on the new fence, we have a cost of $2,000. The fence is 15-year property, eligible for a half-year convention. Prior depreciation claimed on the fence was $461. Current year depreciation is $77. We add those two numbers together, and we get the amount of depreciation entered on Part 1 of Diana's Form 4797, which is $538. We have a cost of $2,000. We reduce the cost by $538, and we sell for $1,200. We end up with a net loss of $262. On the remodeled kitchen, we have a loss of $733, and on the new roof, we have $687. And then, of course, on the sale of the land, we have a profit of $13,000. Now, in Part 3 of Form 4797, we list assets that have had depreciation deductions claimed on them in an earlier year, which are being sold at a gain. And ultimately, it works out that the house, of course, is sold at a gain, but also the refrigerator. So we take a look at the depreciation schedule on that refrigerator, and we can see that the refrigerator that was placed in service in 2007 had an original cost of $500. It's been depreciated double declining balance over 5 years, and prior depreciation claimed on that fridge is $414 for earlier years and $29 for the current year. So we're taking those prior and current year depreciation amounts, adding them together, and we get $443 of prior depreciation. Well, that reduces our basis from the original cost of $500 down to only $57, but this fridge is still worth a couple $100, and therefore there is a gain on the disposition of that refrigerator, and the gain is $143. So this $143 will be reported as ordinary income, but the house itself had a cost basis of $97,100. We're selling it for $140,200. We had prior depreciation of $27,918, reducing the basis down to $69,182 and producing a total gain of $71,018. And of course, the $27,918 of depreciation will be recovered and taxed as capital gain. However, it will be taxed at the higher rate of 25% rather than the lower 15% capital gain rates. The $143 recapture amount is totaled on line 31, and then we move back up to page 1 of Form 4797 and enter that $143 on line 13. We also had the sale of the carpet, but the carpet was placed into and taken out of service in the same year. You can see here that the carpet was placed in service in 2010. It was sold within 1 year of being placed in service. It had a cost of $1,600, and it was being depreciated 5 years, and the prior year depreciation claimed on it was $320. The 2011 depreciation was $256, but the carpet was not held long-term. It was held short-term. Ultimately, it was sold at a teeny tiny gain of $176. So we take the $176 and add the $143. That gives us $319. So moving over again to the upper part of Diana's 4797, we see on line 6 that we enter the gain from line 32 on the previous page. That is the gain on the sale of the rental house itself, $71,018. We add to that the losses and gains from line 2, and on line 7 we total that up at $82,336. The instructions tell us that we need to carry this amount to Schedule D. Then in the lower part of the form we have 2 gains. They are actually ordinary gains. The first ordinary gain is on the sale of the carpet. The second ordinary gain is the recapture of depreciation on that refrigerator. Those 2 gain amounts total $319. $319 will carry to Form 1040 and is entered on line 14 as ordinary income. The other amount of $82,336 will carry to Schedule D, so let's take a look at it. And here is Diana's Schedule D. We move down to Part 2 where we enter long-term gains, and on line 11 we show the amount of gain carrying from Form 4797, and that amount is $82,336. We move over to page 2, and on page 2 it asks us to enter on line 19 the amount of Section 1250 gain, and that is of course the amount of depreciation recovery on the sale of the rental house, which was $27,918. So on Diana's tax return on the Form 1040 on line 13, we enter the capital gains shown on Schedule D, and on line 14 we enter the ordinary gains pulling over from Form 4797. Next up we have line 17, and on line 17 we're going to be reporting the loss from the operational loss of Diana's rental property for the year. Diana had no rental income, but this is a property that was a rental property. And since it was a rental property, even when it was being held for sale, she's allowed to claim her expenses. We gave you very simple expenses: mortgage interest of $4,000, taxes of $500, utilities of $500, and depreciation totaled $1,349. Those 4 expenses totaled $6,349, and we carry $6,349 as a loss to Diana's Form 1040, and that amount is then entered on line 17. We add up all of Diana's income. 90 plus 82 plus 319 minus 6349 gives us $166,306. And on line 40, we enter her itemized deductions. The only deduction she had was income taxes paid to the District of Columbia, and they totaled $7,500. So we've entered that as her itemized deduction. She's also allowed a personal exemption amount of $3,700. And that gives her a taxable income of $155,106. And normally we would go to the tax tables to look up how much tax a single filer owes on that amount of income. But in Diana's case, we can't do that. We need to do the Schedule D worksheet. And here is the Schedule D worksheet. The starting point on the Schedule D worksheet is to take the income from Form 1040 line 43, and that is $155,106. We then enter on line 7 the portion of that number that is capital gain shown on the Schedule D. And then we need to divide that number into the amount that is recovery of depreciation and the amount that is actual increase in value of property. We end up with $54,418 of capital gain that is eligible for the lower capital gain rates, and we have $27,918 that is going to be taxed at a maximum rate of 25%. The next step is to figure the amount of tax that is calculated on each of these levels. And for Diana, we're going to take $54,418 and multiply that by 15%. That is the maximum capital gain rate that applies to the appreciation and value of the property itself. And when we take $54,418, multiply that by 15%, we get $8,163. On the $27,918 of recaptured or recovered depreciation, we need to apply the higher rate of 25%. So we multiply that amount by 25% and we get $6,980. So the next step is to take Diana's income, $155,106, and figure out how much tax she would owe on that just using the tax rate schedules. And the answer to that question is $37,047. So the purpose of the Schedule D worksheet is to figure tax at the reduced rates to see if the reduced rates provide a lower total tax. We've shown the amount of tax attributable to the capital gain at a rate of 15% is $81.63. We've shown the amount of tax on the recovery of the depreciation at a rate of 25% gives us $6,980. But we now have the rest of Diana's income. And the rest of Diana's income that is not eligible for the reduced capital gain rates is $72,770. How much tax does Diana owe on that level of income? And according to the tax tables, the amount of tax owed on that amount of income is $14,319. We then take $81.63, $69.80, $14,319, and we add those amounts together, and we get $29,462. Diana can take the lesser of the amount on line 35 or the amount on line 36. Clearly, line 35 is the lesser number, and so we carry that amount, $29,462, to line 37. We then go to page 2 of Diana's 1040 and enter $29,462 on line 46. Diana had $25,000 withheld on her W-2, so she owes $4,462 this year. Here is Diana's Schedule A. And here is the unrecaptured Section 1250 gain worksheet. I haven't bothered showing you up until this point. Quite frankly, I always say this worksheet is absolutely not necessary. If you understand what unrecaptured Section 1250 gain is, you don't need the worksheet. But the purpose of the worksheet is to figure the amount to enter on Schedule D. The amount figured from the Section 1250 gain worksheet is $27,918, and that was the amount entered on line 19. So that concludes the review of Diana Prince's tax return for the Session 17 homework assignment. At this point, it is time to push pause on video playback and complete the Session 17 quiz. When you are finished taking the Session 17 quiz, please resume video playback for the Session 18 lecture. And it's time to move on with the topic of today's class, which is sale of home, installment sales, and like-kind exchanges. And you may think sale of home, I wasn't advertising that. Well, we can only make the name of our course so long, so we called it installment sales and like-kind exchanges. But we are actually going to start off with the sale of home and all of the different things that you need to know about sale of home. There's surprisingly a lot to know about the sale of home, and it takes quite a while to cover it. Then we'll move on to a discussion of installment sales, and then finally we'll wrap up today's class with a discussion of like-kind exchanges. Now, if you are a super dedicated tax professional who wants to know all that you can know about any particular topic, I always include reading assignments with my classes, and those are really for people who just want to study a topic and really get a handle on it. There are 3 publications really that focus on the content of today's class, and they go in the order of the class. And the first one is publication 523, Selling Your Home. If you want to know anything more above and beyond what I tell you about selling your home today, or you want additional illustrations, that's the place to go. The next publication is 537 on installment sales, and as with selling the home, I'm covering really the areas that I feel are the most important. But again, if you feel like you need more material, more research, that's the publication to look at. And finally, publication 554, Sale and Other Dispositions of Assets, is where you're going to go for information on like-kind exchanges. So there is no like-kind exchange publication. They've just buried it in with sales and other dispositions of assets. And then finally, the simplest version of any topic to read is usually Pub 17. Pub 17 will highlight only the most basic information, but sometimes that's enough. And so I point that out as well. And we're going to begin at the top of page 2 with sale of home. And sale of home, there is reason to be confused by it, and more on the side of taxpayers than on tax preparers, but probably for both. And one of the big reasons for the confusion is that there was a complete, total change in the law beginning in 1997. Prior to 1997, the rule was that if you sold your home
and you sold it at a profit, that profit was taxable. And back then, the maximum capital gain rate was 28%. So you were paying 28% of the profit on the sale of your home. And I can remember doing tax returns for taxpayers for whom that was a great hardship. They'd sold their home, and what little cash they got from it, they had to give some of it or a good part of it away. I can remember one lady in particular who was almost devastated by how much tax she owed on the sale of her home. So it was a big hardship. Now, you could get out of that particular deal of having to pay tax on the sale of your home if you purchased a replacement home within 2 years and the cost of that replacement home was equal to or greater than the selling price of the old home. And so that used to be a motivator, that people would be looking to sell and buy within 2 years a replacement home of equal or greater value. And today there are people sitting around who still own homes that fall into that category. If you bought a home early 1997 or earlier, and that home was your second home, odds are you rolled over the gain from the first home into that home. And so we can't ignore rules that were in place, what is now 15 years ago, because there are still homeowners out there who've been in their home for at least 15 years or longer who can be impacted by them. So we are going to cover that kind of, I don't want to call it a trade, but that kind of sale that turned into a repurchase. So we're looking here at this paragraph. Did you file Form 2119 to postpone the gain on the sale of your home before May 7, 1997? There are going to be quite a few people out there for whom that is true. And so if you did postpone the gain on the sale of your home, that gain that you postponed, in other words, the profit that you did not pay tax on at that time, has reduced your cost in the home that you now own. So for example, you purchased a home back in 1997 as a replacement, and you purchased it before May 7, 1997. So let's just say in February of 1997, you purchased a new home to replace an existing home that you had. And the new home cost $250,000, and the old home sold for $200,000. So you've stepped up in cost. That was a requirement at the time. And then you look at the old home that you sold for $200,000, but you paid only $100,000 for it. So you had a $100,000 profit in the sale of that old home. That $100,000 profit is a profit you did not have to pay tax at that time because you purchased a replacement home within the time frame required. But that $100,000 profit that you did not pay tax on reduced your cost in your new home. So even though you paid $250,000 for the new home, your cost in it would be $150,000. So the 2119 form that was filed back in those olden days was used to report to IRS the fact that you had sold a home, that you were deferring gain on the sale or excluding gain on the sale because you had purchased a replacement home of equal or greater value. So it's really only relevant for cost basis calculations today. Clearly, if a person has been in their home for 15 or more years at this point, they can sell the home and exclude up to $250,000 of gain if they're single, up to $500,000 if they're married. But calculating how much gain they actually have to exclude would be dependent upon whether or not they had a basis reduction because of an earlier sale. So that's what this particular paragraph is talking about. Then we move on to the once-in-a-lifetime $125,000 capital gain exclusion on the sale of a home for taxpayers aged 55 or older. I can remember back in those old days people talking about waiting to turn age 55 so they could sell their house and take advantage of this exclusion. And it was called a once-in-a-lifetime exclusion. Well, it's no longer once in a lifetime. It no longer exists at all. And if you claimed the once-in-a-lifetime exclusion of $125,000 in an earlier year, you are not precluded from claiming the exclusion that exists today. Rules for sale of home after May 6, 1997, that's where we exist today. And of course, most people today who own homes probably bought the homes after that date, although there's no scientific basis for that. That's just kind of what I observe. But if you have purchased a home after that date, or rather sold a home after that date, it is possible that you may be able to exclude the gain, and there are two limits on the gain. The first one is $250,000. It applies to all filing statuses except married filing joint, and then you double it if you are married filing joint. The exclusion itself falls under a section code 121, and the rules for excluding gain are that in order to exclude the gain, you have to be selling your main home that you owned and occupied or owned and lived in for at least 2 out of the past 5 years. The IRS defines your main home as being a house, houseboat, mobile home, apartment, condominium. Pretty much any place that you live and call your home that is suitable to call a home is going to be a home as far as the IRS is concerned. Now, your main home is generally the home that you live in most of the time, and if you own more than one home, only one of your homes is your main home. There is a provision for a reduced maximum exclusion, and generally you can claim an exclusion on the sale of your home only once every 2 years. However, it is possible that you may be entitled to claim a partial exclusion if you sell your home within the 2 years after you purchased it. And you are allowed to claim a reduced exclusion if the sale occurs because your health changed, or you changed your place of employment, or for other unforeseen circumstances that are, well, reasonable that would cause you to be forced to sell your home early. If you qualify for that reduced exclusion, you can claim the exclusion on your home for a prorated amount based on the length of time you lived in your home during that 2-year period. So here is an illustration of what we mean by calculating a prorated exclusion or a reduced exclusion. Sam bought his home on 10/10 of 09 for $150,000, and then on 1/10 of 11, he moved to Arizona to begin working at a new job. He sold his home for $180,000, so he has a $30,000 gain in here. But Sam is able to exclude all of his gain as follows. He looks at the number of months he lived in his home as a percentage of 2 years. So 15 months divided by 24 months. And then he multiplies that by the maximum exclusion amount of $250, and that gives him $156,250. Well, $156,000 is clearly more than his gain of $30,000, so he is able to exclude his entire gain without a problem.
Password number 1 is SWORD, S-W-O-R-D, SWORD.
How to figure the gain or loss on the sale of your home. You accurately figure the gain or loss on the sale of your home by maintaining accurate records. And accurate records are, of course, something that every tax preparer wishes their client had, but very often we come up dry in that category. And one of the reasons for that, I believe, is a little bit of confusion on the part of tax preparers, and maybe even, well, on taxpayers and possibly on tax preparers as well. The IRS constantly tells you to maintain your records for 3 years. It does say that. But what it really should say is 3 years after the year you file and report whatever it is the income or gain is. So in that respect, let's just suppose you own a home for 20 years and then you sell it. How long do you have to keep your records for? Well, that would be 23 years. The 20 years that you lived in and owned the home, and 3 years after you sold it and reported the sale on your tax return. So that's 23 years is much longer than 3 years, and people don't like to keep records for that long. They start to whine and complain that they're taking up too much space in the boxes and in their file cabinets, and can't they please get rid of them. But when it comes to sale of your home, it's really important to hold on to these records because these records are used to establish your cost. So the types of records that you need to keep are records that show anything to do with the purchase of the home, refinances on the home, as well as any improvements you make to the home, including landscaping, a new roof, new plumbing, new wiring, improvements like room additions, decks, patios, fences, etc., and remodeling costs for kitchen, baths, basements, etc. Closing papers from the purchase and sale of your home from any refinances or home equity loans that you used for home improvement, and records for any depreciation you may have claimed for business use of your home. So let's look at an illustration here of a couple who has owned a home, and over the years they've done a few things to it. And I put this illustration together based on the types of things I see my clients do all the time, especially in the olden days before 1997. This kind of calculation was even more important then because we really were trying to button down a net profit that we had to report on the return. Today we're trying to button down a net profit to see if that net profit is greater than or less than the exclusion amount in most cases. But the formula is still really important. So Mr. and Mrs. Harper bought their home in 1989 for $70,000. their closing papers from that purchase show that they paid $1,500 in closing costs at the time. Then on May 10 of 1997, they refinanced their home for $150,000 and used all of the proceeds of the new loan to remodel and make other improvements to their home. They paid $1,500 in closing costs for that refinance. Then on August 10 of 2006, they refinanced their home again for $250,000. This time, the proceeds were used to pay off credit card and car loan debt. $5,000, however, was held out to replace the roof. At that time, they paid $2,500 in closing costs. Then on August 9 of 2011, they sold the home for $285,000. They paid $17,100 in real estate commissions to their agent and another $2,500 in closing costs. To figure the gain on the sale of their home, we have to add up the following amounts, and we begin with the purchase price. We then add in the closing costs from that purchase, as well as home improvements they made back in 1997 and the closing costs from the refinance that were used to fund the home improvements back in 1987. Then in 2006, they did that refinance, but most of the refinance had nothing to do with improvement to the home. The refinance was for other reasons, and therefore closing costs associated with that refinance should not be added to the basis because they were really not associated with the house itself. They were associated with other things. However, the $5,000 they did pull out and use to do home improvements in that year do add to basis. So we add all of those numbers up and we get an adjusted basis of $158,000. And then we look at how much they sell it for, and we subtract out the closing costs on the sale as well as the commissions on the sale to get the amount realized from the sale. Now the amount realized from the sale subtracted from the amount realized on the sale, you subtract out the adjusted basis to get the profit on the sale. And this is the part that confuses people because they feel that however much they walk away from the sale with is their profit. Now, if they sell the house for $285,000 and they pay off the existing mortgage of $250,000, actually we're saying that the existing mortgage at the time of the sale is $243,000. So they take their amount realized from the sale, they subtract out the mortgage balance that they owe at that time, and they're left with only $22,400. Well, there's a lot of homeowners out there that would think $22,400 is their profit. And there's probably a few tax preparers out there who might think the same thing. But it's a far cry from the true profit, which is $107,400, and the amount what they're left with at the end. And so as you can imagine, in the olden days, before we were able to exclude gain, you could have a person having to pay tax on $107,400, and they might not have it, especially if the tax rate was 28% and all they were left with at the end was $22,000. They wouldn't have it. They'd be in the hole tax-wise before we even get to state taxes if they had those. So there was a great hardship for people back in those days, and the new rule allowing you to exclude gain is a pretty darn good deal. Now, of course, that gain or exclusion amount of $250,000 has not been adjusted for inflation since 1997. So over time, I can see we can get to a point where housing prices will go up enough that if there is no adjustment to it, we could hit a day where, even after claiming the exclusion, people will still have a tax situation. Now, there is no tax actually owed on that $107,400 of realized gain because it is less than the $500,000 excludable gain that is allowed under current law. So let's look at how we would go about reporting the sale of a home today. Generally, if you meet the rules for excluding the entire gain on the sale of your home, there is no need to report the sale on your tax return at all. However, you should still report the sale of your home, or you are still required to report the sale of your home if either of the following is true. Number one, you received a Form 1099-S, or your gain from the sale of your home is greater than your exclusion amount. And here is an illustration. On February 5, 2011, Peter and Betty Homemakers sold their home, or homeowners sold their home for $795,000. The homeowners purchased their home back in 1969 for $20,000. And over the years, they spent $12,250 on improvements to their home. They also paid $40,000 in commissions and other selling expenses. They received a Form 1099-S from their title company, calculate and report the homeowner's taxable gain from their sale as follows. So we begin with the purchase price, what they paid back in 1969. Doesn't that look like a dream, buying a house for $20,000? Then the improvements, of course, add to their cost, and the selling expenses technically add to their cost as well. It makes their adjusted basis $72,250. The gross proceeds from the sale are $795,000. We minus out that adjusted basis amount to get $722,750 as the gain on the sale. And the exclusion amount subtracts from that to leave you with the taxable gain. So even though their profit is $722,000, they're only going to be in a situation where they need to report and pay tax on $222,000 of that amount. So how do they go about doing that? Well, firstly, we have the 1099-S, which is showing the gross proceeds from the sale is $795,000. And the rule is that whenever you're reporting a transaction for which you have received an income document, you never want to have a number on the return that is less than the number on the income document. If there's any way to trigger a letter from IRS or an audit from IRS, it's having a difference there. Now, you can be higher, just never less. So in this case, we're equal, which is just wonderful. So we carry the $795,000 down to this new form, new for 2011, called 8949. This is not a replacement for Schedule D. It is rather an augmentation or in addition to Schedule D. And 8949 and Schedule D always go hand in hand. And on 8949, we actually report the sale itself, $795,000. We describe the sale as main home. And then in column B, we enter Code H. Code H tells the IRS that we are going to be claiming an exclusion with the home under Section 121. Then in column C and D, we enter the date acquired and the date sold. And then in column F, we enter the adjusted basis of the home. So earlier on up here, we said the adjusted basis was $72,250. That is the number that is carrying and getting entered here in column F. And then in column G, we enter the amount of gain that is being excluded under Section 121, which is represented with this Code H. Now, nowhere on this line, curiously, does it show what the profit is or what the taxable profit or taxable gain is. 8949 in my mind is a little bit confusing and problematic because you can't see the net number on the end on a per transaction basis. It makes it difficult to see what you're doing. And the old Schedule D did allow you to see the gain or loss on each transaction as you went, but 8949 doesn't do that. So from this point, we actually have to carry the numbers that appear in these three columns on line 4 over to the Schedule D. And they go, in this case, in the long-term section on line 10. And here we enter the sales price, the cost, the amount that we're excluding to arrive at the net taxable gain or loss. So the net gain or loss is listed as a sum total on line 10 of Schedule D. And that would be how you'd report it. And of course, the amount shown on line 15 of the Schedule D will carry to Form 1040 and get entered on line 13. And you will also need to do a capital gain worksheet to figure the amount of tax owed on that. For 2011, the maximum tax owed on this at the federal level would be 15%. Next topic we're going to look at is recapture of depreciation on the sale of your home. While most people are able to exclude the $250,000 or $500,000 gain amount on the sale of their home, there are still instances where sale of home can result in a taxable gain even when the overall gain is less than the exclusion amount. And if you claim depreciation on your home after May 6, 1997, you must recover depreciation you claimed on your home to the extent of the amount of depreciation you claimed or your net gain, whichever is less. Now, what this is saying is it only applies to gain after May 6, 1997 or depreciation after May 6, 1997. So what this means is if you claim depreciation on your home earlier than that, you don't have to recover that on the sale. That is not going to be a part of the exclusion calculation. It's only depreciation since that date. And here is an illustration. Chloe Sullivan sold her home on June 30, 2011 for $165,000. Chloe used her home for business and claimed allowable depreciation deductions on her home totaling $4,000. Chloe's adjusted basis in her home is $100,000 and she purchased it back on October 10, 2005. Chloe will need to recover depreciation she claimed after May 6, 1997. Depreciation she claimed after May 6, 1997 is reported on Schedule D on line 19. We need to complete Form 8949 and Schedule D for Chloe as shown on the next 2 pages. So we again describe the sale as main home. We again claim an exclusion amount and indicate that we are claiming an exclusion by putting code H in column B. Again, we put the date acquired and the date sold. We put the sales price and the cost. But if you look at the difference between cost and sales price, the profit is $65,000, isn't it? 165 minus 100 is 65, but she doesn't get to exclude all 65. She cannot claim an exclusion for any part of the profit that can be attributed to depreciation claimed after May 6, 1997. And that profit attributable to depreciation is $4,000. So she reduces her exclusion amount by $4,000. So it goes from $65,000 down to $61,000. And we then carry that $61,000 number over to column G on the Schedule D. We show the sales price in column E, we show the cost in column F, and the exclusion amount being only $61,000, so that the profit of $4,000 shows up in column H. We carry that to line 15 of Schedule D, and then on page 2 of Schedule D, we carry the $4,000 figure down to line 19. Line 19 is significant because it tells you to carry whatever number you enter there to the Section 1250 gain worksheet. Or actually, you're supposed to fill out the Section 1250 gain worksheet and then carry it to line 19. To me, that worksheet is rather redundant. The worksheet is used to tell you how much gain to enter on line 19, but it's kind of self-evident. The next step is to fill out the capital gain worksheet. And the capital gain worksheet will show you that you need to calculate tax at a maximum rate of 25% on that $4,000. So while most gain, long-term gain, is taxed currently at a maximum capital gain rate of 15%, recovery of depreciation is taxed at a maximum rate of 25%. And she will figure how much tax she owes on that $4,000 by completing the capital gain worksheet. So that's an illustration of a home that a person has lived in this case, Chloe, lived in her home. She had some business use of the home over time and claimed some depreciation for that. But in essence, she's selling her main home. And it's not a business transaction. It's merely a transaction where she is going to have to pay tax on that depreciation she benefited from in earlier years. But if you sell a home that was used for business, things are a little bit different. So let's take a look at that. If you sell property that was, or pardon me, if you use property as a home and partly for business, then how you report that gain is going to depend on whether the business use of your home was a part of the home that you physically live in, or was perhaps attached to your home but still separate from it. So let's look first at part of home that was used for business or rental. If the part of your home that you used for business or rental is within your home, such as a room used as a home office for your business, then your entire home is still considered to be your home for tax purposes. And you should apply the following rules when you sell your main home, which was partially used for business. Firstly, you do not need to allocate the basis of the property and the amount of profit that you realize from the sale between the business part of the property and the part you use as a home. Also, you do not report the sale of the business or rental part on Form 4797, and this is true whether or not you were entitled to claim any depreciation deductions. Finally, you do need to recover and pay tax on any part of the gain that is equal to any depreciation deductions allowed or allowable after May 6, 1997. So I already just showed you how to do that with Chloe Sullivan. So even though Chloe had business use of her home, there was nothing that appeared on Form 4797. No part of the transaction was carried there. She simply reduced her exclusion amount on Schedule D and paid tax on the amount of depreciation she had previously excluded. But the rest of the gain was not taxed. Now let's move on to another example, sale of home that is a separate part of the home. We have a separate part of property that is used for business or rental. You may have used part of your property as your home and a separate part of it for business or to produce rental income. Examples are a working farm on which your home is located, or an apartment building in which you live in one unit and then rent the others out, or a store building with an upstairs apartment in which you lived. So these are pretty easily identifiable separatenesses, aren't they? So they're clearly saying if you keep an apartment inside your home, or essentially a room inside your home, you're okay. But if somehow you separate your home into 2 units or 2 addresses, that's where we're going to have an issue. IRS says that the use test is not met for the separate business part that is attached to your home. You cannot exclude the gain on the separate part of your property used for business or to produce rental income unless you owned and lived in that part of your property for at least 2 years during the 5-year period ending on the date of sale. If you do not meet the use test for the business or rental part of the property, you will need to allocate the basis of the property and the amount realized upon its sale between the business or rental part and the part that was used as a home. So here is an example. Jessica is self-employed and lives in a duplex which she owns. Jessica lives in the larger half of the duplex, which is 60% of the building, and she runs her business from the smaller duplex, which is 40% of the building. She has owned and occupied her duplex for the past 4 years, and she has operated her business from the duplex for the past 4 years as well. Jessica sold her home in 2011, and she can exclude gain only on the $60,000 or the 60% portion of the duplex that was her home. She must report any gain or loss on the sale of the business use of the duplex that was used for her business. So let's look at some numbers. She lived in the home, 60% of the property, therefore she can exclude 60% of the profit on the sale. And she used 40% of the property for business. The 40% that was used for business is not a part of her home. It is separate from it, and therefore she will need to pay tax on the 40% of the gain that is attributable to the business part. In addition, she is also going to have to recapture and pay tax on any depreciation she claimed on her duplex after May 6, 1997. Now, there used to be, in the olden days this time is actually not that far ago. We're talking any time before 2009 and after May 6, 1997, where there was a tax saving strategy in place that said if you have business use property, for example, a home that you've used for rental or business purposes, you can still exclude the gain on the sale if you move into it and meet the 2 out of 5 year test before you sell it. But that tax saving strategy is now defunct. It no longer works for any business use of the property that occurs after 2008. So let's summarize this a little bit. Prior to 2009, a common tax saving strategy was to convert a non-qualified home that was used for rental, vacation even, or investment purposes to your main home. The 2 of 5 year rule could then be met if you made the rental or vacation home your main home for at least 2 out of 5 years. This tax saving strategy no longer applies if gain from the sale or exchange of your home is allocable to periods of non-qualified use after 2008. So here we have a non-qualified use discussion, or what it means, non-qualified use. Generally, non-qualified use means any period in 2009 or later where neither you or your spouse or your former spouse used that property as a main home. But a period of non-qualified use does not include. So what we're saying here, clearly, if you're not living in the home, it's not being used for personal use. So we call it non-qualified use. But the IRS is saying there could be periods of time where you don't live in the home and it's still going to be considered qualified use. So that's what we're going to talk about here. So any portion of the 5 year period ending on the date of sale or exchange that is after the last date you or your spouse used the property as your main home. So let's suppose you live in the house for 10 years and then you move out for 2 years and then you sell it. Those 2 years that occur after the last time you lived in the house are considered to be qualified use. They are not considered to be non-qualified use. Therefore, you're not going to have to pay tax that is attributable to those 2 years that occurred after you moved out. Also, any period not to exceed an aggregate of 10 years during which you or your spouse is serving on qualified official extended duty as a member of the Uniformed Services, as a member of the Foreign Service of the United States, or as an employee of the intelligence community. So it's quite foreseeable that you would purchase a home and you're in the military and you get transferred to Europe for 5 years, and while you're in Europe you rent out your house. And after you're finished in Europe, you get transferred somewhere else in the United States for another 3 years before you finally retire from the military and move back into that house. That period of time where you weren't living in your home because you were on extended military service is still going to be considered qualifying time, as long as you meet the 2 out of 5 year rule in the 5 years before you sell. And finally, any other period of temporary absence not to exceed an aggregate period of 2 years due to change of employment, health conditions, or other unforeseen circumstances as may be specified by the IRS. So technically what they're saying here is even if there was non-qualified use followed by personal use, that non-qualified use may be deemed to be qualified use if you can show that there was non-qualified use because of a temporary absence, because of illness or job or something along those lines. Now, let's assume that you don't have any justification for absence, that basically you moved out and decided to rent the property for profit purposes, and then you moved back in again. What's going to happen in terms of calculating the portion of gain that you are allowed to exclude, or how are we going to determine how much of the gain is taxable because it's attributed to non-qualified use? And there's a formula for that. You need to allocate the gain on the sale between qualified and non-qualified periods of use, and to figure the portion of gain that is allocated to the period of non-qualified use after 2008, you need to multiply the gain by the following fraction. Total non-qualified use during the period of ownership in 2009 or later over the total period of ownership. It's an interesting formula because, in a way, I don't see it getting you out of the fact that the home may have been non-qualified use for many, many years. It does give you credit if you lived in the home, however, for many, many years before 2009. So we have an illustration here where we have a fully excludable gain on a person who moved into the home, lived in it, moved out, rented it, and then sold it. And then after this, we're going to look at a situation where a person has a non-fully excludable gain, or you could say a partially taxable gain, even though they actually rented it for less time. So let's look. William owned and used a home as his main home from 2005 through 2008. Then on January 1, 2009, he moved to another state. He rented his home from that date until April 30th, 2011, when he then sold it. During the 5-year period ending on the date of sale, which was May 1, 2006 through April 30, 2011, William owned and lived in the house for more than 2 years. So he meets that 2 out of 5-year rule. He's going to be able to exclude his gain. The question is there any period of non-qualified use that occurred before the last time he lived in the house? And the answer is no, because if we look at the 5-year period, we have 2006 through 2008, 32 months where he used it as main home. He then moved out and rented it for another 26 months, but all 26 months falls after the last time he lived in the house, and he can show that in the 2 out of 5-year period, he lived in the home at least 2 years. He is able to exclude his entire gain. Of course, he will still have to recover any depreciation he claimed on Schedule D at a maximum rate of 25%, but because this is a sale of a rental property at the time of sale, he still does need to report the sale on Form 4797 as well. So 4797, he'll be able to take advantage of his full exclusion amount, but he will need to recover and pay tax on depreciation that he claims during that period of time. So I showed you an example of a person who lived in his home, then moved out, rented it until he sold it, and he was able to exclude all of his gain except depreciation. Now we're going to look at another situation where we have a taxpayer who is not able to exclude her entire gain because she too rented it, but her conditions are slightly different. June Cleaver is single. She bought her home on May 1, 2001 and lived in the home until December 31, 2009, when she moved out and began renting it. June rented her home for a full year until December 31, 2010, and then she moved back into the home and lived there until she sold it on June 1 of 2011. She owned the home for a total of 3,683 days. June can exclude gain on the sale of her home because she owned and lived in the home for at least 2 years of the 5-year period ending on the date of sale. However, her exclusion will be prorated based on the total number of months she lived in the home and the number of months the home was used as a rental after 2008. And here is June's records. She paid $100,000 for the home, and at that time she also paid for a title search, and she paid taxes owed by the prior owner. She also invested money into a kitchen remodel. And then she sold the home for $270,000. At that time, she paid selling expenses, including commissions, of $18,000. And after May 6, 1997, she claimed $3,345 of depreciation. So in our earlier example, we had a man who lived in his house. He then moved out and rented it and then sold it. And because all of the rental use occurred after he moved out, but he still lived in the home 2 out of 5 years before he sold it, he could exclude all of his gain with the exception of depreciation that he needed to recover. June Cleaver is different. She does things in the slightly wrong order, in a big enough wrong order that it creates a problem for her. So in June's case, her occupancy period is 48 months. So that's 4 out of 5 years. She's plenty in the time frame for that 2 out of 5 year rule. In fact, she more than beats it. She's got 4 out of 5 years. The problem is that she moves out of the house and rents it for 12 months, and then she moves back in. So she has a period of non-qualified use that is before a period of qualified use. And that's where IRS says we have a problem. Now, of course, in this illustration, it's possible June could come up with an excuse like I moved because of a temporary job, or I moved because of my health, and I just rented it and moved back in. But we're not giving those excuses. And this particular illustration actually comes from the IRS publication. So, or the foundation for this illustration comes from IRS's publication. So this is what the IRS is offering up, and I've just interpreted it and turned it into a more coherent problem. So her problem is she doesn't have a reason or a good reason for her non-qualified use, and she has non-qualified use that occurs after 2008 and before she moves out permanently, before she moves out permanently and sells. So now the situation could be different. If she had lived in it for 43 months and then rented it up until the date of sale, she'd be fine. So she moves out, rents it for 12 months, moves back in, and it's a moving back in this situation that creates the problem. So even though June lived in the home for 48 out of 60 months, she has non-qualified use occurring after 2008 and for a period of time before she finally moves out permanently. So IRS says that you need to do some worksheets to figure out what portion of her profit from the sale of the home will be taxed. And it's a series of worksheets, all of which are used to maneuver numbers in a specific way to arrive at a period or a percentage of the gain that's going to be taxed. Worksheet number 1, you can see it coming up down here, but the summary of what happens on worksheet 1 is you begin with the purchase price of the house, $100,000. And then we add in some of the expenses she had with the purchase and home improvements and so forth. She paid for title search costing $500. She paid back taxes for the prior owner, and she made improvements in the form of a remodel to the kitchen, all of which increase her basis to $112,000. But we then have to reduce her basis by the depreciation she previously claimed to come up with the adjusted basis on her house of $108,655. If we move over to this particular worksheet, it takes all of that same information and gives it dedicated lines. And IRS, of course, creates worksheets to help walk the taxpayer or the tax preparer through the thought processes that help you arrive at an adjusted basis amount. You don't need the worksheets if you understand the law, but the worksheet helps walk through the law so you don't miss any steps. And it goes essentially in the same order. She takes her purchase price, she adds in expenses of the purchase, she adds in her home improvement to arrive at her, essentially her basis in the home. We then subtract out depreciation to arrive at her adjusted basis after depreciation. Worksheet number 2 then looks at the selling expenses and the selling price of the home to arrive at the realized gain from the sale. So we start with the selling price of the home, which is $270,000, and then we subtract out expenses of the sale at $18,000, and then we minus the adjusted basis of the home of $108,655 to get the gain from the sale itself. And worksheet 2 walks you through all of those same equations to arrive at that same $143,345 number. So worksheet 2 actually has 2 parts, and we've just looked at part 1. Part 2 is used to figure the exclusion amount and the taxable gain that she will have. And what happens with worksheet 2, part 2, is we look at the gain from the sale that was calculated in part 1 of worksheet 2, and then we subtract out the depreciation. And the purpose of that is to figure out how much gain is attributable to gross profit without regard to depreciation, or gross profit without regard to the depreciation. Then, of course, we have to figure the depreciation separately, and it's still going to get taxed at the highest rate of 25%. And then we're looking at this $140,000 profit not attributable to depreciation. And the next phase is to figure out how much of this profit is going to be taxable because of the non-qualified use. To figure the percentage of non-qualified use, we take the number of days that the home was rented after 2008, which is a full year of 365 days, And then we also look at the number of days that June owned the home, which was 3,683 days. We divide these 365 by 3683, and we get slightly less than 10%. We get 0.099. And we're going to figure the portion of the gain that is taxable based on that percentage. So we look at the gain without regard to depreciation, multiply it by that percentage amount of 0.099, and we get $13,860 of gain that is attributable to a period of time of non-qualified use. And that gain is going to be taxable to her. We also have to look at how much of the gain is going to be attributable to that recovery of depreciation, and we're going to see how that fills in on the worksheet in just a minute, or on the tax forms in just a minute. So we take that $13,860 of gain that is taxable, and we subtract that from the total gain to arrive at the amount that June does not have to pay tax on, which is $126,140. That's the amount of the exclusion she can claim. She's going to enter that on her Form 8949 in column B with a code H. And she's going to also check box C on that particular form. So I'll show you that in just a second. We figure her taxable gain by looking at the portion of the gain that is taxable based on the percentage of non-qualified use, and to that we add the gain that is allocable to depreciation to come up with her total taxable gain. This is the amount that's going to carry to Schedule D and also to the front page of her Form 1040 and get entered on line 13 as the total taxable gain. But this taxable gain has two components: the capital gain portion, which is taxed at a maximum rate of 15%, and the recovery portion, which is taxed at a maximum rate of 25%. So here is Worksheet 2, Part 2. We're taking all of the same information, entering it on the form to finally arrive at this $126,140, which is June's exclusion amount. I'm just going to zoom in on the page a little so you can see it a little more clearly. We've got Form 8949. We're taking the exclusion amount that we figured using all of those worksheets, and we're entering that in column G. That's the amount of gain she does not pay tax on. We enter main home as the description, and the code is H. We enter the sales price and the cost or other basis. We then go over to Schedule D and carry those numbers from line 4 of 8949, because they carried down here, you see. We carry those numbers over to Schedule D and enter them on line 10. And this is long-term totals from all forms 8949 with box C checked in Part 2. Cost or sales price 270, cost 126. Adjustments to the gain, that is the amount she's allowed to exclude and not pay tax on, is 126, and the amount of tax or amount of gain she does have to pay tax on is the $17,205. We're not done. IRS is still interested in how this gain will be taxed, and remember, $13,860 is going to get taxed at a maximum rate of 15%, but the $3,345 is going to get taxed at a maximum rate of 25%. So those numbers get broken apart on page 2 of Schedule D, with $17,205 being the total gain on line 16 and $3,345 being reserved or held out based on calculations we do on the Section 1250 gain worksheet, which we give you in some of our assignments, but is kind of a waste of time worksheet if you ask me, because if you know what you're doing, you simply don't need that worksheet. Tax software always generates it, though. And finally, we would be doing a capital gain worksheet to figure out the amount of tax June owes on her gain, and we really can't tell how much tax she owes on her gain without figuring all of her other income and deductions to finally arrive at her taxable income amount, and then we use the worksheet to figure out all of the various taxes that she owes. Next in line is recapturing or paying back a federal mortgage subsidy. Loans from, actually basically if you purchased your home, in certain situations you may qualify for a federal mortgage subsidy, and we talked about one of those in particular in an earlier class I taught called Federal Tax Credits for Individuals. The big one that we talked about in that class was the mortgage credit certificate. But there's another kind of mortgage subsidy called loans from tax-exempt qualified mortgage bonds. If you qualified for either of those benefits, there are rules that are tied to them. And if you fail to follow through with all of those conditions, then you may have to recapture or pay back some of the tax benefits or subsidies you received as a result of those benefits. So how does that happen? Well, the tax or the recapture tax applies to loans that came from the proceeds of qualified mortgage bonds or were based on mortgage credit certificates. The recapture also applies to assumptions of these loans. So when does the recapture apply? Recapture of federal mortgage subsidy applies only if you meet both of the following conditions. You sell or otherwise dispose of your home at a gain within the first 9 years after the date you close on your mortgage loan. So the first-time homebuyer credit has this 3-year ownership and occupancy rule. Not so hard to meet a 3-year rule. 9 years, that's tougher. Not so many people stay in place for more than 7 years. I think 7 years is kind of like the average length of time people own a car and the average amount of time they keep a job, and maybe even less than that for jobs. So holding on to a home for 9 years might be a challenge. So this is something that could periodically come up. I say it could periodically come up. It's just that almost no one takes advantage of these subsidies in the first place. So first we have to narrow it down to the number of people who actually take advantage of the subsidies, and then among those, the number that fail to live up to the 9-year rule. Now, if also you have to live in it less than 9 years, but you have to have income for the year of disposition that is more than the year's adjusted qualifying income for your family size for that year. So when the recapture does not apply, recapture does not apply in any of the following situations. Your mortgage loan was a qualified home improvement loan of not more than $15,000 that was used for alterations, repairs, and improvements that protect or improve the basic livability of the home or energy efficiency of the home. Or your qualified loan was not more than $150,000 and was used to repair damage from Hurricane Katrina or other homes that were destroyed in the disaster area of the Gulf zone. You disposed of your home more than 9 years after the date you closed on your mortgage loan. If you did, you don't have to recapture. Or you transfer the home to your spouse or former spouse incident to a divorce and there is no gain included in your income. You dispose of the home at a loss. You don't have to do a recapture. Or the home is destroyed by a casualty and you replace it to its original site within 2 years after the end of the year when the destruction happened. The replacement period is extended for main homes destroyed in federally declared disaster areas. Or you refinance your mortgage loan unless you later meet the conditions listed previously under when recapture applies. Notice of amounts. At or near the time of settlement of your mortgage loan, you should receive a notice that provides the federally subsidized amount and other information you will need to figure the recapture tax. How do you refigure the recapture tax? You fill out Form 8828. And I've put an image of Form 8828 in here, but I'm not going to spend any time discussing it. It's such a rarity. I felt it's enough to explain that it exists, and if you ever get to do one, you're on your own for figuring it out. All right. Next, we're going to talk about the recapture of the first-time homebuyer credit. Haven't had to deal with any yet, but I'm sure they are coming. If you recall, there were 3 different first-time homebuyer credits out there. There was essentially the 2008 credit that went into 2009. There was a 2009 credit, and then there was another 2009 credit that went into 10 and possibly carried to 11. So the last one is the one that went the longest and was the broadest in scope. It allowed the highest level of income. It also allowed for a long-term resident credit where if you owned and occupied your home, I think it was 5 out of the last 10 years, something like that, you could qualify for long-term resident credit of up to $6,500. That particular credit and the one that preceded it, the 2009 credit, the only thing you have to do to not have to recapture those credits is live in the home 3 years or more. You're good to go. The other credit, the 2008 credit, was only ever intended to be a loan. And people who took advantage of the 2008 credit received a credit of $7,500 with a rule that they have to begin making repayments in 2010 at a rate of $500 a year. Now, when the 2008 first-time homebuyer credit came out, I thought that was a whopping good deal. I thought, wow, an interest-free loan? You know, you get your down payment now, you buy the house now using that $7,500, and over a 15-year period, you have to pay $500 a year back. Ah, that's nothing. I thought that was a fantastic deal. And then they made it better. Now you get $8,000 and you don't have to pay any of it back as long as you meet the occupancy tests. So I've just explained kind of in a nutshell the 3 different kinds of credits that are out there, and each one of them had rules and conditions for receiving the credit, which are, it's kind of a little bit of a waste of time even to talk about them because they're kind of history. But if you're interested in the rules on who has to repay them, I'm going to leave you to read that on your own. But I am going to show you a brief illustration here of the 2008 repayment. It's an illustration I've shown in an earlier class, but I'll repeat it here for those of you who have not seen it before. Of course, the 2008 repayment works at a rate of $500 a year beginning in 2010. But what happens if you sell the home earlier than 15 years? Obviously, you're going to have this difference, and do you have to pay it back? And the answer is yes, you do. If you sell your home at a profit, or to the extent that you sell your home at a profit. So here we have an example. Johnny sold too soon, received a $7,500 first-time homebuyer credit for 2008. He purchased his home on July 1, 2008 for $250,000, and his adjusted basis in the home is figured by taking the $250,000 acquisition price and subtracting out the first-time homebuyer credit. That gives him an adjusted basis of $242,500 for our illustration, assuming no other improvements have been made to the home since he purchased it. Johnny repaid $500 properly, as he should have, with his 2010 return, and then he sold the home on June 30th, 2011 for $253,000. At that time, expenses of the sale totaled $4,500. His net gain from the sale is figured as follows. He takes the purchase price of the home, $250,000, and subtracts out the first-time homebuyer credit of $7,500. He then adds back in the amount of first-time homebuyer credit he has already repaid to arrive at his new adjusted basis in the home. He then looks at the sales price of the home, subtracts out selling expenses to get the adjusted basis, and then he gets the gain on, or not the adjusted basis, minus the adjusted basis to get the gain on the sale. So we're trying to get to this $5,500 figure to determine how much of a profit he has. And his recapture is going to be the lesser of his profit from the sale or the amount of unpaid credit. Well, at this point, having only paid back $500, the amount of unpaid credit is $7,000. But his gain on the sale is only $5,500, so the gain on the sale is what is going to get taxed. And that is not taxed as income, it's taxed as a tax. So he's going to have to pay it in full. Here is the worksheet for Form 5405. It essentially takes all of these same numbers and arranges them slightly differently to arrive at that same bottom line figure of $5,500. And then you enter the $5,500 on Form 5405, page 2 on Part 3. Part 3, you indicate that you sold the home to a person who is not related to you. Then in Part 4, you indicate the repayment amount, and you start with the amount of original credit. You subtract out any repayments made after you purchased the home to arrive at the net amount of credit still owed. And then you enter the smaller of that net credit or the profit on the sale. And in this case, the smaller amount is $5,500. $5,500 carries to Form 40, or 1040, page 2, and is entered on line 59B. So no worksheets for that one beyond the 5405 worksheet. This is a straight tax. It's going to add to how much he owes. So we're on to installment sale income next. Installment sales, I don't know if the IRS RTRP exam is going to test on these. I can tell you and promise you that here in Oregon, where we have the only state in the nation that does test on tax preparer knowledge, that this is a tested topic. And at the Oregon tax preparer test and at the tax consultant exam, which is a higher level exam, this topic is one of the most frequently missed. Each year the Oregon Tax Board publishes a list of the most frequently missed questions, and each year this one is on it. So pay attention in today's class so you can pass that question on the Oregon test. And obviously if you're studying for the C exam, the IRS's enrolled agent exam, for sure they will ask about this topic. Whether the RTRP does, I'm uncertain. But at any rate, let's take a look at installment sale. An installment sale is a sale of property where you receive at least one payment after the year of sale. The installment sale rules, however, do not apply to sales of the following: the regular sale of inventory, stocks or securities traded on established securities market, although earlier in history those were allowed, and it is possible that under old rules that existed a long time ago, you could still have an installment sale going on that refers to securities, but in modern times, in recent history, you have not been able to do an installment sale on securities. And finally, if you sell property for a loss, that is not reported under the installment method either. General rules. If a sale qualifies as an installment sale, the gain must be reported under the installment sale method unless you elect not to use the method or the property sold does not qualify for the method. So this is one of those IRS rules that says you have to, unless you make a deliberate move to not follow the rule by saying to IRS, I elect out of it. So when IRS has the default rule applies automatically unless you elect out. And typically you're given a window of time in which you can elect out. And if you fail to elect out during that window of time, you can't get out of it later on. So if you fall into that window, it typically will automatically apply. Now when you figure your installment sale income, each part on an installment sale usually consists of the following three parts: interest income, a return of your adjusted basis in the sale, and the gain or profit on the sale. For each year that you receive a payment on the sale of your property, you must include the interest part in your income as well as the part that is your gain on the sale. But do not report in income the part that is a return of your cost in the property. Interest income, you must report interest income as ordinary income. And IRS says that when you have an installment sale, there is always interest. You cannot choose to give an interest-free loan. You can't make the profit that qualifies for capital gain treatment inflated by making interest zero. But there's always interest of some kind, and if you do not make an agreement on the rate of interest and apply that in your contract, then IRS can come along later and decide what that interest rate will be and make you pay tax on that rate of interest. Now you also, on each payment, have a return of basis and a portion of the payment that is a gain on the sale. And the rest of each payment is, so the rest of each payment you receive is broken into those two parts. So you make a payment, let's just say your payment's $1,000 a month. IRS is going to say a certain amount of that payment is going to be interest, a certain amount is going to be profit from the sale, and a certain amount is going to be a return of your cost on the sale. And the installment method worksheets and the gross profit percentage that you work or determine on those worksheets will establish what portion of each payment is a return of principal and what portion is capital gain that is taxable to you. Separate from that is a calculation that goes on for the amount of interest. So to figure what part of any payment is gain, multiply the payment less interest by the gross profit percentage. Well, how do you arrive at the gross profit percentage? The IRS has this little worksheet here to help you figure that out. You begin on line 1 by entering the selling price of the property. You then enter your adjusted basis for the property, and then you enter your selling expenses. Finally, you enter any depreciation that you need to recapture. You add those lines together and you get your adjusted basis for installment sale purposes. You then subtract line 5, which is your adjusted basis, from the selling price, and this is your gross profit. If the amount entered on line 6 is 0, stop here. You're not allowed to use the installment method. You then enter the contract price for the property and divide line 6 by line 7 to get your gross profit percentage. Well, there's no way to make sense of that without some illustrations, so we're going to go through them. Let's begin with some of the terminology appearing on this. The first one is selling price. The selling price is the total cost of the property to the buyer. It includes any money, the fair market value of any property you are to receive, any debt that the buyer assumes or pays on the property sold, and any selling expense that the buyer pays for the seller. The selling price does not include interest, whether stated or unstated. Installment sale basis. There are 3 items that comprise the installment sale basis, and they include the adjusted basis, any additional selling expenses, and any depreciation recapture. You must figure your installment sale basis before you can calculate your gross profit percentage. We then move on to the contract price. Contract price equals the selling price minus the mortgages, debts, and other liabilities assumed or taken by the buyer, and the amount by which the mortgages, debts, and other liabilities assumed or taken by the buyer exceed your adjusted basis for installment sale purposes. And finally, the last word or terminology that we saw in that worksheet is the gross profit percentage. Your gross profit percentage is the amount of each payment that is to be reported as gain from the sale. The gross profit percentage generally remains the same for each payment you receive. However, if you agree to reduce the selling price at a later time, you will have to figure your gross profit percentage for the remaining payments. That's come up, at least in our company, where we've had installment sales get rearranged. That, after the deal closed and after a certain number of payments are made, the seller's having cold feet saying, I'm ready to walk away from this deal unless we renegotiate. And the seller has an option at that point of foreclosing on the loan and repossessing the property or agreeing to renegotiate. We've had that certainly come up because of our collapsed real estate market. I'm not going to go through what to do with that because it's a pretty rare animal, but if you do have a situation like that where you've got that happening with a client, there are 2 or 3 pages of instructions on how to refigure the gross profit percentage in the IRS publication for installment sales, which is 537. So I would refer you there for that. So let's take a look then at 6252. This is the form that gets filled out to report installment sale income. Use the form to report an installment sale in the year of sale and also to report payments received in later years. You attach it to your return each year you receive payments. Form 6252 helps you determine your gross profit, the contract price, the gross profit percentage, and how much of each payment received during the year you should include in income. So this worksheet we just went through right here is essentially built into the form. You can say the worksheet works next to the form, but when you're all done, the form does the same thing. 6252 is divided into the following parts. Part 1 is used in the year of sale to figure the gross profit and the contract price. Part 2 is filled for the year of sale and for any year you receive a payment or are considered to have received a payment. And Part 3 is completed if you sold the property to a related person. In the year of sale, you will answer questions at the beginning of the form and complete Part 1 and Part 2. Line 3 asks you if you sold the property to a related person or party, and if you answer yes to that question, you also complete Part 3. For later years, you answer the questions at the beginning of the form and complete Part 2 for each year in which you receive a payment on the sale. So let's take a look at each of the component parts. Payments received, including payments that you are considered to have received. You figure your gain each year on the payments you are receiving or are treated as receiving from an installment sale. These payments include the down payment you receive on the date of sale and each later payment of principal principal on the buyer's debt to you. So in other words, your payments include whatever down payment you get at the time you sell, plus any future payments you receive over time that are paid towards the principal amount of that buyer's debt to you. In certain situations, you are considered to have received a payment even though the buyer does not pay you directly. This occurs if the buyer assumes or pays any of your debts, for example, mortgages or taxes that you owe, or pays any of your expenses, for example, sales commissions. Seller-financed mortgage. Special reporting procedures apply, or special reporting procedures apply if you are selling under a seller-financed mortgage, and those are that the portion of each payment that is interest, obviously that interest is taxable to you, and the IRS wants you to identify the fact that you received interest under a seller-financed mortgage by entering the amount of mortgage interest you received on line 1 of Schedule B for your Form 1040 or 1040A. And they want you to identify the person or party that is paying you with their name, address, and Social Security number as well. Schedule D, sale of personal use property. If your installment sale was held long-term, you figure your gain using Form 6252. You carry the taxable portion of the gain to Schedule D, and then you carry the amount from Schedule D to line 13 of your Form 1040, and you pay tax on it at capital gain rates. But if you sold business use property under an installment sale, the sale is figured on 6252 and on Form 4797 almost simultaneously or hand in hand. And you're going to do computations on 6252. You're also going to do computations on 4797. And in a way, 4797 gets filled out first, but you can't finish filling out Form 4797 until you carry numbers from it to 6252, and then from 6252 you go back to the 4797. So that's one of the most complex calculations I've ever forced a student to do in our school. I used to have that exact kind of computation in our basic tax course, and my students complained, so I made it simpler. To this day, I don't torture anyone with it in a working problem, but it can come up if you sell business assets on an installment sale. Electing out of the installment method, how do you do that? If you elect not to use the installment method, you generally report the entire gain in the year of sale, even though you do not receive all of the sales proceeds in that year. So how do you elect out? Well, you figure your gain on Schedule D or Form 4797, and you report the entire gain and pay tax on it in the year of sale. You don't need to make any special attachments to the return. All you do is figure the gain in its entirety and report it on your return, pay tax on it. You're done. That's how you make the election. When do you make the election? You need to make it by the due date, including extensions for filing your tax return for the year of sale. Automatic 6-month extension. If you timely filed your return without making the election, you can still make the election by filing an amended return within 6 months of the due date of your return, not including extensions. So essentially, once October 15th passes, you're out of luck. Got to use the installment sale no matter what. Revoking the election, can you do that? Only if you get IRS approval, and if you want to know how to do that, read Publication 537. I promised you a detailed illustration. Here it is. Installment sale that is reported on 6252. This is Sally's sale, and she sold her vacation home. It's a vacation home, so she can't exclude the gain under sale of main home rules. It's going to be a taxable sale. She paid $5,000 in expenses and sold the home for $350,000. She originally purchased her home back in 2001 for $150,000. She claimed $2,000 of depreciation on her home in prior years. She must have had a little bit of business use in there. Sally received $18,000 in payments for the year, of which $12,000 was applied to the principal amount of the loan and $6,000 was applied to interest. Her W-2 is shown below. Begin by preparing her Form 6252 to calculate her income from the installment sale. Now, I've thrown on a W-2 here because anytime we do a tax return for an individual, there's usually more income than just the topic that we're talking about. And in this case, we decided to give Sally $50,000 of wage income and $8,000 of withholdings, just to give you something interesting to work through on some worksheets. And here is her installment sale form. And if you've got it in color, I try and coincide the description boxes to the portion of the form that I'm talking about. So looking at this green section here, and seeing if I can zoom in a little bit for you. All right. So the first part, lines 1 through 4, we provide information describing the property that is sold. And we enter a description, we enter the acquisition date, we enter the sales date, and then there are 2 questions about sales to related parties. And in Sally's case, we're going to say no, those don't apply. We then move on to part 1, which is the beginning of the formula where we work out the gross profit and the contract price. And on line 5, we enter the sales price, $350,000. Line 6 is where we enter mortgages that have been assumed by the buyer. And in this case, no mortgage is assumed, so we leave it blank. And therefore, line 7 and line 5 are the same number. We then enter on line 8 the cost basis. And you will see then on line 9 there's space to enter depreciation allowed or allowable. I want to point out that there is another line, line 12, where we enter income recapture from Form 4797, which is for recapture depreciation. But that recapture rule technically applies to Section 1245 property, which is personal property and not real estate. So rarely when we're looking at an installment sale for an individual who is selling a house on installment or a real estate type property on installment, are you ever going to have an entry on line 12? Because depreciation is recovered rather than recaptured when we sell real estate. And recovery of depreciation goes up here on line 9. And recovery of depreciation essentially reduces your cost basis. So her adjusted basis in this property drops from $150,000 to $148,000. And then on line 11, we enter expenses of the sale to arrive at her installment sale basis on line 13. We then take her installment sale basis and subtract that from the selling price to arrive at the number entered on line 14. So this is essentially what her gain is, you could say. And the next step is to divide the gain by the contract price. So we divide that gain or gross profit by the contract price of $350, and we get her gross profit percentage, 56.286%. The next step is to enter in the payments that she received during the year. That was $12,000 of payments. We're going to multiply those amounts by 56.286%, and we get $6,754. That is the amount of income she has from the installment for the year that is capital gain, and that is the amount that she's going to carry to Schedule D and enter on the appropriate line of Schedule D. So let's go do that. Now, Schedule D is a two-part form, and I've got page 1 of the form with page 2 superimposed over top here. And on page 1 of the form on line 11, we enter gain from form 4797 or part 1 long-term gains from forms 2439 and 6252. So 6252 is where we figured her gain, and we enter that on line 11. We're not done yet because she had previously claimed depreciation on that home. We have to separate out of that gain the portion of the gain that is attributable to prior depreciation. That's $2,000. That $2,000 is relevant because it determines how we're going to figure her capital gain on the capital gain worksheet. Now let's take a look at the front page of her 1040. I told you in the wording of the problem that she had a $50,000 W-2, and we've entered that on line 7. And I also told you that she had received interest payments from the buyer totaling $6,000. And interest is, of course, reported on line 8A. And because this is a seller-financed mortgage, she also has to report that interest income received on Schedule B, where she indicates the name of the buyer, the Social Security number of the buyer, and the address of the buyer. Then on line 13, she enters the capital gain from the sale of the property that is being taxed this year based on installment payments and the gross profit percentage being applied to those payments. Now we go over to page 2 of the Form 1040. And we start with her adjusted gross income as shown on page 1. We take her standard deduction amount of $5,800, get her income after the standard deduction, claim her personal exemption amount to finally arrive at her taxable income. Now, most of the time when you arrive at taxable income, the next step is to go to the tax tables to figure out your tax. But whenever you're dealing with capital gain, you don't do that. Instead, you take the taxable income figure from line 43 and enter it onto the Schedule D tax worksheet. And this Schedule D tax worksheet has you go through and figure the amount of gain that she has that's capital gain, and from that subtract out the amount of gain that is a recovery of depreciation. It also has you figure out how much of this income up here is not anything to do with capital gain at all, and in this case we get $46,500. We go to the tax tables to figure out how much tax she owes on this number, and the answer is $7,756. We then look at the portion of the figure that is not attributable to depreciation, that is the amount of the $6,754 of gain that has nothing to do with depreciation, and that's $4,754. That number is taxed at a maximum rate of 15%, and the tax on that is $713. We also look at the $2,000 of gain that is subject to the highest rate of tax on recovery of depreciation. $2,000 gets taxed at 25% and totals $500. So the total tax she's going to enter on her Form 1040 is $713 plus $500 plus $77.56. That gives us $8,969, and we take that up and smack it down on line 44. The only step left is her withholdings of $8,000. Her withholdings are slightly low, so she owes $969 when she files.
Password number 2 is ring bearer. R-I-N-G-B-E-A-R-E-R. Ring bearer.
Now, let's look at another illustration or another concept. I just showed you an illustration where it's just a direct sale. There's no assumption of loan. In today's real estate market, I could see there might be some people out there who are assuming loans, right? Because a loan assumption goes on when you've got a person who needs to sell, you have a person who needs to buy. The person who needs to buy can't buy with their own financing, so they're looking to have someone help them along. But maybe the someone who is willing to sell to them has a mortgage that they can't afford to pay off. Right? So there needs to be some kind of an assumption that goes on there, and that's what we're going to talk about now. So buyer assumes the mortgage of the seller. What happens then? Well, you must figure your gain each year on payments you receive or are treated as receiving from the installment sale. You are considered to have received a payment even though the buyer does not pay you directly, such as the buyer assumes or pays any of the seller's debts, such as a loan, or pays any expenses of the seller, such as a sales commission. However, the buyer's assumption of the seller's debt is usually treated as a recovery of basis rather than as a payment in many cases. Now, there are situations where IRS describes a loan that qualifies for mortgage assumption and only reduces basis, and other situations where an assumed mortgage would be treated as a payment. And I didn't want to get into that in today's class, but there is more information in Publication 537 on that if you care to read it. For today, we're going to keep it simple and say that most of the mortgages out there that are secured by homes are going to be qualifying mortgages. And that's how we're going to treat them in our illustration. If the buyer pays seller's expenses, then the seller will treat those payments by the buyer as income from the sale. If the buyer assumes the mortgage or otherwise takes property subject to the mortgage, then the following rules apply. Firstly, if the mortgage is less than the basis, if the buyer assumes a mortgage that is not more than in your installment sale basis in the property, it is not considered to be a payment to you. It is considered a recovery of your basis. The contract price is the selling price minus your mortgage. So let's look at an illustration here. You sell property with an adjusted basis to you of $190,000, and you have selling expenses of $10,000. The buyer assumes your existing mortgage of $150,000 and agrees to pay you $100,000. That is a cash down payment of $20,000 and $20,000 each year for the next 4 years. Since the buyer is assuming your mortgage, you must include the assumed mortgage in your selling price of your property. The contract price of the sale, however, is equal to the cash payments received, $100,000. However, you must reduce your basis in the property by the amount of your assumed mortgage. This is actually a pretty good deal. The formula-wise how it works out. So here's the 6252 filled out for you. I've knocked off the top and the bottom just to focus on the stuff we care about. And we start with the selling price of the property, which includes cash to be paid as well as the assumed mortgage. And then on line 6, we enter the amount of mortgage that is being assumed, $150,000, to arrive at, you could say, the amount of payment that's actually going to be made from the sale, $100,000. We then look at the cost or other basis in the property of $190,000. There are no other adjustments to that basis except for commissions and other expenses of sale, which increase the installment sale basis and carry it over to be $200,000. Now we look at this $200,000 amount and subtract that from $250,000 to arrive at the profit from the sale. And of course, we then look at the gross profit as a percentage of the contract price being this $100,000 figure right here, and we end up with a gross profit percentage of 50%. Now during the year, the payments received were $20,000, and the gross profit percentage is 50%, therefore the gain realized for the year that will get taxed is $10,000. So that's what it looks like when the mortgage assumed is less than the basis. What happens if the mortgage assumed is more than the basis? If the buyer assumes a mortgage that is more than your installment basis in the property, you recover your entire basis. The part of the mortgage greater than your basis is treated as a payment received in the year of sale. To figure the contract price when the assumed mortgage is more than your basis, you begin, and this formula is a little bit hard to understand. I mean, I wrote it, I practiced it, I read it, and I'm still having a hard time explaining it and fully understanding it. But in the end, it all works out. If you follow the form, it'll arrive at these conclusions for you. So you start by subtracting the mortgage from the selling price. This is the total amount other than interest that you will receive directly from the buyer, the cash payments in other words. Add to this amount the payment that you are considered to have received, which is the difference between the mortgage and your installment sale basis. You then have the contract price, which is the same as the gross profit from the sale. So in other words, your gross profit percentage in that kind of situation is always going to be 100%. Here's an illustration. The selling price of your property is $90,000. The buyer will pay you $10,000 annually plus 8% interest over the next 3 years and assume an existing mortgage of $60,000. Your adjusted basis in the property is $44,000 and you have selling expenses of $6,000 for a total installment sale basis of $50,000. So the mortgage is $60,000. your installment sale basis is 50. So that means that the basis is less than the price, or less than the mortgage, and therefore you're going to have to recover part of the assumed mortgage as a payment during the year. The part of the mortgage that is more than your installment sale basis is $10,000. That's 60 minus 50. This amount is included in the contract price and is treated as a payment received in the year of sale. The contract price of $40,000 is calculated as follows. You begin with the selling price and subtract out the assumed mortgage to figure the amount that you're actually receiving. You then figure out how much of the amount of assumed mortgage exceeds basis. Well, the assumed mortgage of 60 is greater than the basis of 50 by $10,000. You then take this 10, add it to the 30 to get the contract price of 40. And then you finally figure your gross profit. You take the selling price, you subtract out the basis in the property, and you have a profit of 40. So the contract price and the profit are the same in this formula, giving you a gross profit percentage of 100%. So we fill out the form and it all works out. We start off with $90,000 as the selling price. We then look at the mortgage being assumed and we subtract that difference out and we get 30. We get the cost or other basis, add in the selling expenses to get the installment sale basis. Next, we subtract line 13 from line 5 and we get 40,000. We have a gross profit therefore of 40, but we have to subtract line 13 from line 6 and that gives us 10. And then we end up with a contract price of 40. So again, we're back to this 100% gross profit percentage. Now what happens is that this $10,000 of payment that is attributable to the difference between the cost basis and the assumed mortgage is treated as a payment in the year of sale. And so we have two numbers entered on the installment sale income section. One is the actual payment received during the year, and the other is the amount of payment deemed to have been received. And so payments received for the year are $20,000, and 100% gross profit percentage means $20,000 is going to carry to Schedule D and over to line 13 of the Form 1040. So those are all sales of basically personal properties not used for business. What happens when you have an installment sale that is attributable to a business? More complicated then, really complicated. Sale of business under the installment method. The installment sale of an entire business for one overall price under a single contract, IRS says, is not the sale of a single asset. Now earlier in our class last Thursday we spent quite a bit of time looking at sale of assets, including Form 4797, and how when you sell the assets of a business, the IRS wants you to divide those assets into separate classes for reporting on a particular IRS form called 8594, Asset Acquisition Statement. That asset acquisition statement is used to identify the classes of assets that were sold so that IRS can determine how those different categories are going to be taxed or what kind of treatment they should receive on the tax return. And so 4797 goes hand in hand with 6252 when you have sale of assets that were used in a business. And it also goes hand in hand with this particular form 8594. So we talked about Form 8594 and how to fill it out in our last class called Sale of Assets. I'm not going to go through that form today. I'm just mentioning it. So we need to allocate our selling price on that sale of asset form, and to determine whether any of the gain on the sale of the business can be reported on the installment method, you must allocate the total selling price and the payments received in the year of sale between each of the following classes of assets. Number 1, assets sold at a loss. Number 2, real and personal property that is eligible for the installment method, and real and personal property that is not eligible for the installment method, including inventory, dealer property, and stocks and securities. Inventory, this is a question I get a lot from my online students. How do you deal with sale of inventory when you sell it with a business? Well, IRS is pretty clear about what you do when you sell inventory. The sale of inventories of personal property cannot be reported under the installment method. All gain or loss on their sale must be reported in the year of sale, even if you report payment in later years. Where do you report it? You report it as gross income of the business itself. It's not capital gain. It's part of cost of goods sold. So people are often confused by this. Well, what do you mean the inventory is gone? How do I claim it? But when you look at cost of goods sold, you have an opening amount, your opening inventory. Let's say you start the year with $10,000 in inventory. And as the year goes on, you buy more inventory, maybe another $30,000 of inventory. And as the year goes on, you're selling inventory. So at the end of the year, you might have $10,000 of inventory. So if you start with 10, end with 10, and buy 30 in the middle, your cost is 30. It's pretty sensible. But if you start the year with 10, pay for 30, and end of the year with 0, your cost of inventory would be 40, right? So how do you account for the cost of inventory on an installment sale? Well, you're going to account for it that you don't have it at the end. It's going to be 0 at the end. And how do you account for the income? Well, the income is going to be income of your business, and you'll report it as such on your Schedule C or whatever other business form you're filing in place of Schedule C. The IRS also refers to something as residual method. It talks about it frequently in different places. One of the places is here under sale of business assets. Except for assets exchanged under the like-kind exchange rules, both the buyer and seller of a business must use the residual method to calculate or to allocate the sales price of each asset that they sell from a business. This method determines the gain or loss from the transfer of each asset and the buyer's basis in the assets. Well, in our class on installment sales, we did just that. We allocated or identified each asset being sold on Form 4797 and independently figured the gain or loss on the sale of each individual asset, as well as any recover or recapture of depreciation on each asset sold. That's what the residual method means. And when you carry the residual method over to an installment sale, IRS is saying you need to go through all of those calculations under the residual method on Form 4797 to determine how much you even get to do an installment sale on, and then you carry those totals over to the 6252. So we're going to have a very simple illustration of that coming up in a minute. So the residual method provides for consideration that you receive from the sale to first be reduced by cash and general deposit accounts, including checking and savings accounts, but excluding certificates of deposit. And then the consideration remaining after this deduction must be allocated among the various business assets in a certain order. And this order actually follows exactly the order of Form 8594. So we're looking at something kind of that seems arbitrary or by itself as a rule, but if you take this particular paragraph and line it up next to Form 8594, you'll see how they go hand in hand together. For asset acquisitions occurring after March 15, 2001, you make the allocation among the following assets in proportion to, but not more than, their fair market value on the purchase date in the following order. Number 1, certificates of deposit, including U.S. government securities, foreign currency, and actively traded personal property, including stocks and securities. Well, most people are not going to sell a business that includes securities. So rarely do I fill this section out, but it is potentially possible. We then go to accounts receivable, and you certainly could sell a business that has accounts receivable. That could happen. And if you have accounts receivable, part of the selling price has to be allocated to that, and is item number 2. Item number 2 is property of a kind that would be properly includable in inventory on hand at the end of the year. So inventory has to be separated out and cannot be included with other assets sold. We then move on to all other assets except Section 197 intangibles, and that's pretty much like the building, equipment, the tangible things that you can see and touch that are not intangible. And then intangible itself is divided into 2 categories. The first category is Section 197 intangibles except goodwill and going concern value. And the final category is goodwill and going concern value. So all of these different classes of assets that make up the sale of a business have to be separately identified. And you are allowed to go installment method on some of them, but not on others. So there's 2 purposes to filling out the asset acquisition form. One is to identify the classes of assets. The other is to identify the tax treatment that will be given to each of those categories of assets. And one of the final ones, again, is to determine which of the assets are of a type that can qualify for installment sale treatment if you're selling your business under the installment method. Now, there should be an agreement between the buyer and the seller on how this breakup will occur, but very often there is not. So very often when the client comes into us, they've just agreed that the business is going to be sold. I'm going to sell you my convenience store for $300,000, lock, stock, and barrel. And you go, okay, we're done. So what do we do at that point? Well, we've got the going concern value of the store, which is an intangible. We've got the workforce in place. We have goodwill of the business clientele that have been coming there for many years. Those are intangible numbers that have value. Part of the value of that business is due to those intangibles. There's also all of the inventory sitting on the shelves on the day it turns hand. That has value. If the building is owned, there's going to be value in the cost of the building. There's going to be value in all of the fixed assets that are not inventory as well, and those all have to be identified and broken out. Sometimes us lowly tax preparers are the ones that have to do that. Other times it's already been done in the agreement. But whether or not there is an agreement, both the buyer and the seller are required to complete Form 8594, and on that form identify how the allocation is going on. Now, ideally, you will both fill out 8594 the same way. And I can think of in recent history where we had that exact kind of situation where there was no agreement on the breakdown of price, and so we were doing that after the fact, and we essentially filled out 8594 for the buyer and sent a copy to the seller, so the seller had a kind of a record of what we were doing. But the seller didn't really have a clue about anything either, and who knows what his tax preparer told him. So sale of partnership interest. IRS says that a partner who sells a partnership interest at a gain may be able to report the sale on the installment method. The sale of a partnership interest is treated as the sale of a single capital asset. The part of any gain or loss from unrealized receivables or inventory items will be treated as ordinary income. The term unrealized receivables includes depreciation, recapture income. So ultimately, IRS is saying that when you sell your interest in a partnership, you're selling a single asset, but you're still going to have to determine inside that sale of that partnership how much of the value needs to be attributed to these individual items. So that's a pretty complex calculation, not one I'm going to be teaching you today. For more information on the treatment of unrealized receivables and inventory, see publication 541. That would be a whole class all by itself, probably an all-dayer. Recapture of depreciation for Section 1245 property. Well, in our class on sale of assets, we talked about the difference between Section 1245 property and Section 1250 property. Section 1245 property and Section 1250 property are both Section 1231 property. Okay, so Section 1231 property is maybe the mother, and then we've got two children underneath her, Section 1245 property and Section 1250 property. So whenever you're talking 1245 or 1250, you are also talking 1231. But when we sell a Section 1231 asset, we need to identify whether the asset sold was Section 1245 property or Section 1250 property. How do we do that? 50 or 1250 is always real estate. It is land and buildings, anything growing on the land or attached to the land. And anything else we ever sell is Section 1245 property, as long as it's not inventory, stock, and trade, or so forth. So Section 1231 property is property that can be depreciated or amortized. So it would never include inventory. Therefore, inventory is not Section 1231 property, nor is it Section 1245 property. Making sense? Now, when we do sell Section 1245 property under an installment sale, the rules are that we have to recapture depreciation at that time if there's any part of the profit that is attributable to depreciation. So Section 1245 property is property used in a trade or business for which depreciation was allowed or allowable in an earlier year. If you report the sale of property under the installment method, any depreciation recaptured under Section 1245 is taxable as ordinary income in the year of sale. This applies even if no payments are received in that year. If the gain is more than the depreciation recapture income, report the rest of the gain using the installment method rules. Section 1250 property is a little bit easier. This is real estate that is used in a trade or business, and gain on the sale of Section 1250 property can generally be reported using the installment method, provided the property was held for more than 1 year and was depreciated using the straight line method. If the property was held for 1 year or less, all of the gain is taxable as ordinary income. And here is an illustration. Farmer Brown sells his farm under an installment agreement. His adjusted basis in the land and buildings is $700,000 with accumulated depreciation of $80,000. As a part of the sale, Farmer Brown also sells farm equipment with a basis of $100,000 and accumulated depreciation of $70,000. And how is it that we can have that kind of situation? Well, we can get it quite often because Section 1245 property is usually eligible for Section 179 deduction, bonus depreciation, and certainly the 200% declining balance, or in the case of a farmer, 150% declining balance on depreciation. So it would be pretty easy to get into a situation on Section 1245 property where the cost of the property or the fair market value of the property exceeds your basis because you've taken all of this accelerated depreciation. And this is what's happened with Farmer Brown. So we're going to allocate the sales price of Farmer Brown's farm and equipment as follows. $1 million is for the farmland and buildings, and $80,000 is for the equipment. The buyer's combined down payment and installment principal payments to Farmer Brown totaled $40,000 for the year. Figure Farmer Brown's taxable income for the year of sale as follows. Firstly, Section 1250 property, that was the farm. It sells for $1 million. His basis in the farm is $700,000, and prior depreciation on the farm is $80,000, giving him an adjusted basis in the farm of $620,000. We subtract $620 from the sales price to get his profit on the sale, $380,000. And that profit on the sale is comprised of two parts, $80,000 of depreciation recovery under Section 1250 and $300,000 of long-term capital gain. The $80,000 is going to be taxed at a maximum rate of 25%, and the long-term capital gain will get taxed at a maximum rate in today's dollars of 15%, although in the future it could go up because capital gain rates are pegged to go up after 2012. Then we have Section 1245 property. The equipment sale price is $80,000 and the equipment basis is $100,000, but he's claimed $70,000 of depreciation, giving him an adjusted basis of $30,000. Sales price minus adjusted basis is giving him a gain of $50,000. So even though Farmer Brown received only $40,000 of payments during the year, he needs to report $50,000 as ordinary income from the sale because he must recapture all of the Section 1245 gain in the year of sale. No installment income is reported for the year of sale on the farm itself. So I thought you might want to see how it looks when it's filled out on some tax forms. And because this is a sale of business assets, the starting point is Form 4797. And whenever you're dealing with the sale of assets on Form 4797 where you have a profit and depreciation was previously claimed, you start with Part 3 of the form and report the sale there. And in this case, we're listing two assets sold, the farm and equipment. Now clearly in a more complex example, you would break out the equipment and farm buildings and so forth into different categories, but I'm keeping it simple in my illustration here. Farm and equipment. On the farm we have a sales price of $1 million, a cost of $700,000, prior depreciation of $80,000, an adjusted basis of $620,000, giving us total gain of $380,000. On property B, which is the equipment, we have a sales price of $80,000, a cost of $100,000, depreciation of $70,000, adjusted basis of $30,000, and a profit of $50,000. How much of that $50,000 is Section 1245 recapture? All of it. So on line 25, we enter the amount of depreciation previously allowed or allowable, and then on line 25, we enter the lesser of depreciation allowed or allowable or the profit from the sale, and in this case, the profit is the smaller number. We then go down to the bottom of the form, and on line 30, we enter the total gains from all properties and the portion of those gains that are recapture of Section 1245 depreciation. We then on line 32 enter the amount that's going to be capital gain income for the year. And you can see that the software has entered NA here, and that's because we're not taxing any of the profit on the sale of the farm this year. Rather, we're going to carry that to 6252 and do some computations there. But this $50,000, it doesn't get to go over to the 6252. It gets taxed in the year of sale. So we go from that point to page 1 of Form 4797. And page 1 of Form 4797, normally, if we have any amount of gain carrying from 6252, that would go on line 4. And if there were a profit from the farm sale itself, it would carry to line 4 after, it would go from page 3 of 4797 over to 6252 and then back onto line 4 of 4797. But we're not doing that this year because all of the gain for the year is going to be attributable to the farm equipment. And in fact, the farm equipment is a larger gain than the payments received. So we enter $50,000 on line 13, and that $50,000 will carry to the Form 1040, get entered on line 14 as ordinary income, and he pays tax on it. So what happens on the installment sale form then? Well, we fill out the 6252. We provide a description of the property being sold, the date acquired, the date sold. We answer the related party questions, and then we move on to Part 1, where we enter the selling price of the farm itself, $1 million. There's no amount of assumed mortgage, so line 7 and line 5 are equal. Then on line 8, we enter the cost basis of the property sold. We subtract out any depreciation that was allowed or allowable. Now, I just wanted to point out what IRS means by depreciation allowed or allowable. Depreciation, I like to say, is mandatory. The IRS won't punish you in a particular tax year because you didn't claim it. They're not going to come along and fine you. Hey, you should have claimed depreciation and you didn't, so you're in big trouble. But the punishment comes through the back door in that you are treated as having claimed depreciation when you sell property, even if you never claimed it at all. That's why you'll see sentences on tax forms that read depreciation allowed or allowable. Allowed means you took it. Allowable means you could have taken it, whether you took it or not. So the allowed depreciation and the allowable depreciation, we're going to go with the higher of those two numbers. And in this case, it's $80,000. That reduces Farmer Brown's basis down to $720. And we go over to line 13 with that $720. We subtract it from the million to arrive at his profit. And the profit as a percentage of the selling price is 28%. That's his gross profit percentage. But we've got no payments for the year. All $40,000 is applied to the recapture of depreciation on the Section 1245 property, so his Section 1250 property realizes a no gain for the year. And the final thing I'm going to mention here on sale of property to related persons, you'll notice that Form 6252 has a checkbox if you sell property to a related person. What happens if you did that? Is it not allowed? The answer is yes, it is allowed. It's just that there's some additional parameters or additional requirements if that happens. If you sell property to a related person, there are additional reporting requirements. And they include that for the year of sale, you need to complete lines 1 through 4 and parts 1, 2, and 3 of Form 6252. In addition, you need to complete lines 1 through 4 for 2 years after the year of sale, even if you don't receive any payments in those years. So for the average person, 6252 is filed in the year of sale and any year after the year of sale in which you receive a payment. But if you sell to a related person, for the 2 years after the year of sale, they want you to file the form even if you didn't get a payment. You complete Part 2 for each of the 2 years after the year of sale in which you receive a payment, and you complete Part 3 for each of the 2 years after the year of sale unless you receive the final payment during the year. Generally, a special rule applies if you sell or exchange property to a related person on the installment method, which is referred to as a first distribution, or disposition rather, who then sells or exchanges or gives away the property under a second disposition under the following circumstances. Number 1, the related person makes the second disposition before making all of the payments under the first disposition, and the related person disposes of the property within 2 years of the first disposition. This rule does not apply if the property involved is marketable securities, which you can't even do that anymore under installment method anyway, so that's old stuff. Under this rule, you treat part or all of the amount the related person realizes or the fair market value of the disposed property is not sold or exchanged from the second disposition as if you'd received it at the time of the second disposition. Right, the next topic of the day is like-kind exchanges. Relatively rare animals. I've done a few of them over the years. It seems like I'm asked to do a like-kind exchange about twice a decade. You might have a practice that focuses on them and you see more of them, but mine are just random odds of a client of mine showing up because they did a like-kind exchange or calling me up and asking for an appointment because they did a like-kind exchange. But there are specific rules in place on how to report them, and they're not exactly easy to follow, and trying to do a like-kind exchange in tax software is always rather nightmarish. So we'll look at some of the rules behind like-kind exchanges. So firstly, let's look at the rules. The IRS regulations require deferral of gains and losses on the exchange of property that is like-kind. So the rules are mandatory. If you have a like-kind exchange, well, you have a like-kind exchange and you have to fill out the forms and apply the rules. It's not an optional thing. So installment method or installment sales, you can elect out of the installment method by actually reporting the entire sale or the entire gain on the sale in the year of sale. But with installment sales, you're not allowed to do that. If you have not with installment, but with like-kind exchanges, you can't elect out of the like-kind exchange. If you go through all of the motions of having a like-kind exchange occur, well, it happened. So the rules: an exchange of property will be considered a like-kind exchange only if all of the rules applying to like-kind exchanges are met. And these rules are summarized as follows. Rule number 1, installment or income property only. In a like-kind exchange, both the property you give up and the property you receive must be held by you for investment or for productive use in your trade or business. So if the property that you trade is personal property not used in a business, the like-kind exchange rules do not and cannot apply. Number 2, you must have qualifying property that was traded. In addition to being held for investment or business use, the property must be qualifying property, and certain types of non-qualifying property are not allowed in Section 1031 exchanges. Like kind, both the property given up and the property received must be like kind. 45-day identification period. The property received must be identified within 45 days after the property given up in the exchange is transferred. 180-day receipt period. The property received must be received by the earlier of 180 days after the transfer of the property given up in the exchange, or the due date of the return, including extensions, for the year the property given up is transferred. Rule number 6, boot is taxable. Any money or unlike property received in the exchange is considered to be boot. Liabilities, rule number 7, liabilities assumed by the other party are considered boot. Liabilities transferred to the other party in an exchange in excess of liabilities assumed by the taxpayer are treated as boot. Like-kind exchange rules are mandatory. Gain or loss realized on the exchange of like-kind property must be deferred and is not recognized. Related party exchanges are subject to additional rules. If you sell to a related party who then turns around and within 2 years sells the property again, then you're treated as having received that money in the year of sale. Depreciation treatment. This is an interesting one. The maker's depreciation method, convention, and placed in service date, which applied to the old property, will continue to apply to any basis transferred to the new property. If the basis of the new property is greater than the basis of the old property, any additional amount added to basis will be depreciated beginning on the date of the new property when it was acquired. Sale of home. You may not exclude gain on the sale of your home if you sell your home within 5 years of acquiring it in a like-kind exchange. So how would that happen? Technically, you're not even supposed to acquire property through a like-kind exchange for personal use. But it is conceivable that you would have a rental property that you trade for another rental property, and then after a period of time you decide to convert that rental property into your personal home. If you do that, you can't exclude gain on the sale if you sell within 5 years. Reporting Form 8824 must be used to report the exchange of like-kind property. So that's the rules summarized. We're going to take a little bit closer look at most of those rules, more in-depth look at each one and what they mean. Beginning with investment or income property only. In a like-kind exchange, both the property you give up and the property received must be held by you for investment or business purposes, and examples of property that you can qualify include machinery, buildings, land, trucks, and rental houses. How long does my property need to be used for business to qualify? This is a common question. The IRS gives no specific information or instructions on how long property must be held for investment or business use. However, a good guideline to follow is a minimum of 1 to 2 years. I think the closest I've ever seen in any discussion with an IRS auditor or in any publication anywhere is 1 year. That if you pass that magic 1-year barrier, you're probably safe. And 2 years is just good measure. So although I'm not seeing it defined anywhere as being 12 months, that's kind of a general rule of thumb. Rental property must not have more than 14 days of personal use. Qualifying property must not be used for personal use more than 14 days per year, or 10% of the actual numbers of days that the property has been rented in a given year. So if you have this vacation property that you use as a vacation rental as well and you have some income coming from it, IRS says that particular property is not going to be qualifying under the like-kind exchange rules because it's had too much personal use. Replacement property cannot be purchased with the intent to sell immediately. You cannot defer gain in a like-kind exchange if you intend to immediately sell it. And again, what would immediate be? Well, in less than a year is probably the safe bet. Rule number 2, the relinquished property must be qualifying property. To qualify for tax deferral under the rules for like-kind exchanges, there must be a trade or exchange of qualifying property. Qualifying property is property held for investment purposes or used in a taxpayer's trade or business. Investment property generally includes real estate, whether it is improved or unimproved, held for investment or income-producing purposes. So let's look at some examples here. Qualifying property used in a trade or business can include farmland, office buildings, and rental real estate. Also, equipment used in the trade or business activity, and Section 197 intangibles such as copyright, except for goodwill and going concern value. Property does not qualify for Section 1240 or 1231 exchange includes a personal residence, land under development for resale, construction or fix flips for resale. Now, when the housing market was booming, this was a popular one. People like to buy these houses, work on fixing them up, and then flip them and do the same thing with the next property. And IRS is saying, no, that's not going to qualify for like-kind exchange. You really need to be purchasing in through a like-kind exchange or property that is going to be held for investment or income production. So if you buy the property, fix it up, you're going to need to actually turn it into a rental and have people rent it. And after it's been rented for a period of time, then you could like-kind exchange it into another property. And if you wanted to fix that property up again, you could. But you can't be doing this. Fixer flippers are essentially a business of acquiring property, improving it, and selling it. In other words, the property that you're buying and improving is a form of inventory, and it's not even eligible for capital gain treatment, let alone like-kind exchange treatment. Property purchased for resale does not qualify. Inventory property. Corporation common stock, bonds, notes, partnership interests, goodwill, or going concern value. Rule number 3, the property exchanged must be like-kind. To qualify for like-kind exchange treatment, both the property given up and the property received must be like-kind as defined by the IRS. In addition, property given up and property received must be qualifying property. So determining if property given up and property received are like-kind, well, the IRS says that there are 2 ways to do that. To be allowable, the asset given and the asset received must be like-kind or like-class. Like-kind properties are properties of the same nature or character, even if they differ in grade or quality. Property must generally belong to the same asset class or the same product class. So we go into IRS publications to see some examples of what it has to say about these things. The general asset classes found in the regulations can be summarized as follows. Office furniture and equipment belong to asset class 00.11. And where do you find these asset classes listed? You actually find them in Appendix D of IRS's publication on depreciation, publication 946. And we went through this quite a bit of detail in our depreciation class. Other assets listed in Appendix B of 946 include information systems such as computers and peripheral equipment. Next class is 00.13, which includes data handling equipment such as computers. Number 4, airplanes including airframes and engines, except planes used in commercial or contract carrying of passengers, or freight and all helicopters including airframes and engines. Automobiles and taxis belong to asset class 00.22. Buses are in their own class. Light general purpose trucks are in a different class than heavy general purpose trucks, therefore they're not like-kind. Railroad cars and locomotives, except those owned by railroad transportation companies. Tractor units for use over the road. Trailers and trailer-mounted containers. So each of these are different classes. You can't trade assets in one class for another class and have a like-kind exchange. That's what this is telling you. Vessels, barges, tugs, and similar water transportation equipment, except those used in marine construction and industrial steam and electric generation or distribution systems. So those are all examples of classes of assets. IRS says if assets are in the same class and you trade one asset in a class for another asset in the same class, you have a like-kind exchange. And this is just a summary of some of the asset classes. There are way more than that. But to find out if you've got two assets that fall into the same class, I would go to publication 946 and look at Appendix B. Now, if it doesn't fall into the same asset class, it might fall into the same product class. Product classes include property listed in a 6-digit product class, except any ending in 9. In sectors 31 through 33 of the North American Industry Classification System, or NAICS. For 2011 returns, the last updated NAICS manual is 2007. However, as of 2012, it has again been updated, and I will take you to that manual and show it to you in just a second. But first, let's look at a couple of examples. Example number 1, Charlotte trades a personal computer used in her business for a printer to be used in her business. The properties exchanged are within the same general asset class and are of a like class, therefore the exchange would be a qualifying like-kind exchange. Example number 2, Wilbur trades a grater to Ron in exchange for a scraper. Both are used in a business. Neither property is within the same general asset class. Both properties, however, are in the same product class and therefore are of a like class. So let's go over. If you are a webinar student, you can download this manual and simply click on the link. It'll take you there. I'm going to show you where it takes you, just in case you ever actually need to look this up. So when you click on that link, it takes you to the United States Census Bureau. And you can see we now have a 2012 NAICS search. We're going to take a look at the 2007. And to see those resources, there's a link right here, 2007. You click on it, and it takes you to general descriptions of the different categories or classes of assets, and you can actually download these asset lists. And here's the 6-digit 2007 code files. If I click on this, it opens it up and it shows me all of the different, all the different categories in here. So this information is easily available. It is not hard to find. You can open up PDF versions. There's all kinds of extra information in here. And you can see it was updated in 2002, then it was updated in 2007, and now it's been updated again in 2012. So it appears every 5 years they're updating it. All right, so let's look at a third example. Taxpayer G transfers the following property to H: a personal computer that falls into asset class 00.12, an airplane in asset class 00.21, and a sanding machine under NAICS code 333210. H transfers the following property to G: a printer in asset class 00.12, a car in asset class 00.22, and a saw in NAICS code 333210. The computer and the printer are of like class, and the sanding machine and the saw are in the same product class, so both qualify for like-kind exchange treatment. But the airplane and the car are not in the same general or product classes and do not qualify for like-kind exchange treatment. And I pulled out the NAICS code for 2011. You can see here, 333210, sawmill and woodworking machinery manufacturing. Rule number 4, the replacement property must be identified within 45 days. And this rule is described in IRS Publication 544. You must identify the property to be received within 45 days after the date you transfer the property given up. This period of time is called the identification period. Any property received during the identification period is considered to have been identified. If you transfer more than one property as a part of the same transaction, and the properties are transferred on different dates, the identification period and the receipt period begin on the date of the earliest transfer. How do you go about identifying your replacement property? You must identify the replacement property in a signed written document and deliver it to the other person involved in the exchange. You must clearly describe the replacement property in the written document. The following are examples of acceptable descriptions: the legal description or street address for real property, and the make and model and year of your car. Now, if you are involved in the purchase of a home or the sale of a home through a like-kind exchange, and it would actually be both of those at the same time in a like-kind exchange, wouldn't it? You're selling and you're buying. Well, the intermediary in that exchange is going to be some kind of title company. Somebody has to be in the middle to make the perfection of that like-kind exchange happen when you're dealing with real estate. And so at the time you make an offer to buy a property, that intermediary will have to receive a copy of that binding offer. And at the time you decide that you're selling a property, the property being given up, that also has to be communicated to that intermediary. Now in the deal with a sale with a car, typically you're going to be trading in one car for a new car at a dealership. And there's going to be a written contract right there acknowledging the trade-in of one car and the sale of the new car as a part of that deal. So that paperwork actually is easy to comprehend where it would be and how you would arrive at it. A business has a trade-in. Yes, if you have a car that you used in your business and you trade that car in on another car, that is a like-kind exchange. And when you think about it, that kind of exchange probably happens all the time. And are we even thinking about it as tax preparers when we do tax returns? The answer is probably not. So identifying alternative and multiple properties. Now, as you might imagine, you're involved in a like-kind exchange and you're kind of like, well, I'm going to identify two properties. I don't know which property is the property I'm going to buy, but I have to be identifying these properties within a certain window of time. Can you get away with identifying more than one property? And the IRS says, yes, you can, but there are parameters around that. Firstly, the IRS says the maximum number of replacement properties you can identify is the larger of the following: 3 properties regardless of their fair market value, or any number of properties whose fair market value at the end of the identification period is not more than double the total fair market value on the date of transfer of all the properties you are giving up. If at the end of the identification period you have identified more properties than permitted under this rule, the only property that will be considered identified is any replacement property you actually received before the end of the identification period, and any replacement property identified before the end of the identification period and received before the end of the receipt period, but only if the fair market value of the property is at least 95% of the total fair market value of all identified property replacement property during the year. So that's a tongue twister, hard to read, hard to even comprehend. Quick Finder, of all things, puts together a very nice table that kind of summarizes these rules. There's the 3 property rule, the 200% rule, and the 95% rule. You take the total number of properties that can be identified and the total fair market value, there is no limit. If you identify 3 or fewer, there's no limit on the fair market value. There's also the 200% rule, which says that no matter how many properties you identify, there's no limit on the number as long as the value of those replacement properties is not more than twice the value of the property you're giving up. And then there's the 95% rule. If the value of the properties you're identifying is not more than 95% of the property you're giving up, there's no limit on the number of property. Also, disregard incidental property. Do not treat property incidental to a larger item of property as separate from the larger item when you identify replacement property. Because we could be getting hung up. You know, you're selling one piece of real estate for another real estate, and on the piece of real estate you might have something that you could say was not like property. Are you going to have to worry about that? And the answer is not normally, provided it is typically the type of property that is transferred with the larger item, and that the total fair market value of all of the incidental property is not more than 15% of the total fair market value of the larger item of property. Rule number 5, the replacement property must be received within 180 days. This also comes from publication 544. Gain or loss from a deferred exchange can qualify for non-recognition even if the replacement property is not in existence or is being produced at a time you identify it as replacement property. The receipt requirement, the property must be received by the earlier of the following dates: the 180th day after the date on which you transfer the property given up in the exchange, or the due date, including extensions for the tax year in which you transfer the property. Like-kind exchanges using qualified intermediaries. Now, with trading in one car for another car, or one motorcycle for another motorcycle, if you have an excuse to use a motorcycle in a business, you can see that that type of exchange is going to be pretty easy. You do it at the dealership. But when you're dealing with the sale of real estate, what are the odds that you're going to find someone out there selling their property that's willing to trade you their property for your property, and that you'd even be interested in their property? close to zero. I suppose it's feasible. Hypothetically, it could happen, but in reality, no one even attempts to make that happen because there's people out there who have made it their business to be the middleman. And what happens when you involve a middleman is the middleman says, I will buy the property you're interested in acquiring, and I will also buy the property you're selling. And after I buy the property you're interested in acquiring, I'm going to sell it to you. So I am, in fact, the person you're doing the like-kind exchange with, or the intermediary is the entity you're doing the like-kind exchange with. And this third party out here who's selling the property you're interested in isn't involved in the like-kind exchange at all, other than there's the paperwork hassle and maybe some delays and some problems for them being involved in a deal that involves a like-kind exchange. When I'm the seller of a property and I'm not involving myself in the like-kind exchange, and my buyer is involving themselves in a like-kind exchange, that is a pain, a big pain in the derriere. Okay, so just from a practical standpoint, if I am selling property and I've got two offers coming in and one of those offers says that they're involved in a like-kind exchange, I'm going to go for the other offer, all else being equal, because there's too many hang-ups that could occur to stall the sale or create problems. The biggest among those is these identification periods. I'm interested in buying your property. I'm going to make an offer on your property, but this property I have here, I don't have a buyer for my property yet. So I can't really close on your property till I've sold my property. And you're thinking, well, what's in that deal for me, especially if I have another buyer willing to buy it now? Nothing. But you can get yourself into that situation pretty easily as a seller when you don't realize what a like-kind exchange means for the buyer. It can be a problem. So like-kind exchange using qualified intermediaries. A qualified intermediary is a person who enters into a written exchange agreement with you to acquire and transfer the property you give up and to acquire the replacement property and then transfer it to you. There are 4 types of exchanges as follows. The first one is the simultaneous exchange. This is an exchange in which the closing of the relinquished property and the replacement of property occur on the same day, usually back to back. There is no interval between the two closing. Number 2 is a delayed exchange, also referred to as a starker exchange. This is an exchange where the replacement property is closed on at a later date than the closing of the relinquished property. The exchange is not simultaneous or on the same day, and this type of exchange is sometimes referred to as a starker exchange because of a Supreme Court case which ruled in the taxpayer's favor against the IRS before the Internal Revenue Code provided for this type of exchange. Also a reverse exchange or a title holding exchange. This is an exchange in which the replacement property is purchased and closed on before the relinquished property is sold. And finally, an improvement exchange, also called a title holding exchange. This is an exchange in which the taxpayer desires to acquire a property and arrange for construction of improvements on the property before it is received as replacement property. So let's think how that might happen. You purchase property with a cost of $100,000, but you want to put a $200,000 building on it. And the property you're selling is $300,000. Well, we're going to see that the formula is you have to trade up or across. You can't trade down and have a like-kind exchange. So if you buy this land for $100,000 and you trade for it your $300,000 property, you're going to have $200,000 of boot in that deal, creating $200,000 of potential income. So IRS says you can't do that. What you have to do is make sure that the cost of the property you're acquiring is equal to or greater than the value of, or the sales price of the property you're giving up. And so one way to do that would be to identify the property, get the improvement built on that property, and then close on it. And there are provisions for that. Now, obviously, building it from the ground up would take more than 183 days in most cases, or more than 180 days. But there's probably people out there who figure out how to make it all work. There's also some information in here on safe harbor rules when involving qualified intermediaries. If you want to read more about that, I'll let you do it on your own. Let's move on to rule number 6. Boot received is taxable. The term boot is not used in the Internal Revenue Code or the regulations. It is commonly used in discussing the tax consequences of a Section 1031 tax-deferred exchange. Now, one of the classes I taught a long time ago, a gentleman in the audience said he knew where the term boot came from. He said it had to do with the old cowboy days when two ranchers would trade cattle or trade horses. And if one horse was worth more than the other horse, the person giving up the less valuable horse for the more valuable horse would reach into his boot to pull out cash to pay the difference. And so that's where the term came from. I was told. Okay, so all boot received is considered to be taxable. And all of the following are considered to be boot. Money, including all cash equivalents plus liabilities of the taxpayer assumed by the other party, and other property that is not like kind, such as personal property received in an exchange of real property, property used for personal purposes, or non-qualified property. Other property also includes such things as a profit promissory note received from a buyer under seller financing. The best way to avoid boot is always to trade up by receiving replacement property of equal or greater value than the replacement property. Trading down occurs where the replacement property is of less value than the property given up. Trading down will always result in boot. Partially non-taxable exchanges. If in addition to like-kind property you receive money or unlike property in an exchange on which you realize a gain, you have a partially non-taxable exchange. You are taxed on the gain you realize, but only to the extent of money and the fair market value of the unlike property that you receive. Rule number 7, liabilities assumed by the other party are considered to be boot. Again, IRS Publication 544 describes this. You must offset all liabilities you assume as a part of the exchange against all liabilities of which you are relieved. Offset these liabilities whether they are recourse or non-recourse, and regardless of whether they are secured or otherwise relate to specific property transferred. Rules for avoiding boot. Always trade across or up. Never trade down. This is referred to as the even or up rule. Trading down always results in boot. And boot always means tax. Bring cash to the closing of the relinquished property to cover charges which are not transaction costs. Do not receive property that is not like kind. Do not overfinance the replacement property. Financing should be limited to the amount of money necessary to close on the replacement property in addition to exchange funds which will be brought to the replacement property closing. Rule number 10, maker's depreciation of transferred basis from old property continues under the new property. Now, there was some confusion about this for a long period of time. Some tax returns were being filed with all new depreciation systems and methods being placed in service on the date of the exchange. And other people were continuing with old depreciation that had existed on the old property and placing new depreciation in on the additional stepped up basis in the new property. And IRS wanted to make it clear what they wanted done, and what they wanted done was method 2, not method 1. So in response to this confusion, the IRS issued Treasury Notice 2000-4, also 2000-1 CB 313. These were published on January 18, 2000. These notices provide the following instructions, and you can read them in their entirety. They're a real gripping read, but what it summarizes down to is the replacement maker's property that has a placed in service date after January 3, 2000 is depreciated over the remaining recovery period of and using the same depreciation method and convention as the relinquished maker's property, and that any excess of the basis in the replacement maker's property over the adjusted basis in the relinquished maker's property is treated as newly purchased maker's property. Sale of home. Additional rules apply to the sale of a home if the home was acquired in a like-kind exchange. If you sell your home which is acquired in a like-kind exchange, you cannot claim the $250,000 exclusion if you sell the home within 5 years from the date you acquire the new home in the like-kind exchange. This rule also applies if you received the home as a gift from another person who acquired the home in a like-kind exchange. Rule number 12, report like-kind exchanges on Form 8812. Well, here's the form. And I've divided it into little colored boxes to help sort it into its sections. Section number 1, or part 1 here. For real estate exchanges, you need to provide the address and the type of property. For personal property, just enter a description. Line 5, this is the date that you have a written agreement identifying the replacement property was signed by all parties, and the agreement must not be later than 45 days after the transfer of property given up in the exchange. Line number 6, the replacement property must be received by the earlier of 180 days after the date the old property was transferred or the due date of the return, including extensions. So it's asking for those dates, the date that you identified and the date that the replacement property transferred. Lines 7 through 11, a related party, there's a question here, did you sell to a related party? A related party includes your spouse, child, grandchild, parent, grandparent, brother, sister, or a related corporation, S corporation, partnership, trust, or estate. An indirect exchange with a related party includes an exchange made through an intermediary or an exchange made by a disregarded entity, such as a single member LLC, if you or a related party owned that entity. An exchange between related parties will generally qualify for non-recognition treatment if the property or properties which are exchanged are held for 2 years or more by the related parties. A disposition of any kind within 2 years by either the related parties causes the deferred income to become taxable in the year of original disposition. So you'd have to go back and amend the return to the year of the like-kind exchange and include the income in that year. Then we move on to page 2 of the form where you actually start doing some computations, and this is usually the hard part, figuring out what amounts to enter on each of these lines. On line 12, you enter the fair market value of the other property that was given up in the exchange. On line 13, you enter the adjusted basis of the other property that was given up. Now, the IRS doesn't have any kind of a worksheet for figuring out these numbers. I've spent years hoping that they would, that I could incorporate those worksheets into my class and really show you how to do it. The best I've ever found in terms of a worksheet is on the website of a company called 1031 Corporation. And a lot of the information I've relayed to you in today's class is summarized so well on their website. I have to confess I've taken a little bit from their site and used it. I've also taken a lot from IRS publications, and wherever I can find it in the IRS publication, that's where I usually cite it. But 1031 really has a good handle on this topic. Obviously, they've made a big business out of this, and their website includes a worksheet. If you are an online student, you can actually click on the worksheet in your manual, and it'll take you to that worksheet. Or you can click on the link in your manual, and it'll take you to the worksheet that 1031 Corporation has, and it helps you walk through these. Since it's not an IRS worksheet, I don't actually cover it in the class or how to fill it out because I can't really say it's IRS approved or IRS instructions, but I can say that this company really has a handle on things, and if you filled out the worksheet, you're probably safe. If you just type 1031 Corporation, you'll get there. Yeah. There's all kinds of different 1031 companies out there. If you just type 1031 Exchange, you won't get it, but 1031 Corporation should take you there, and an online student just clicks on the link. Line 15, next line in the form. On this line, you include the sum of any cash paid to you by the other party, the fair market value of not like-kind property you received, if any, and the net liability assumed by the other party that is more than the total of any liabilities you assumed, cash you paid to the other party, and the fair market value of other property, not like-kind property that you gave up. You reduce the sum of the above amounts, but not below zero, by any exchange expenses you incurred. And finally, we get to line 18 right here, which is highlighted in green. On that line, you enter the adjusted basis of the property you gave up, exchange expenses, if any, except those used to reduce the amount on line 15, the net amount paid to the other party in excess, if any, of the total of any liabilities you assumed, cash you paid to the other party, and the fair market value of the other not like property you gave up over any liabilities assumed by the other party. Please note that the instructions for line 18 provide an example of treatment of other property. In referring to the example, it should be noted that the example shows a situation where each party to the transaction assumes the loan of the other property. There is no reference to independent financing through a third-party mortgage company, which is how it always goes. So that's the part that's always bothered me. IRS is not real clear on what it means by assumed mortgage. Does it mean a seller-financed mortgage is assumed, or you take over that assumption of mortgage, or does it mean that you took out a new mortgage and paid off the old mortgage? They're just not clear about that, which bothers me. I complained to some auditors about it once. Okay, so here's an illustration. And we're almost at the top of the hour. For those of you who have to run, I'll give you the last password, and those of you who can stay a few minutes late, we'll go through this illustration together. Detailed illustration. During the year, Josie Wales traded his commercial building for an apartment building in a like-kind exchange using a qualified intermediary. Use the following information to prepare Josie's Form 8824. So we have the commercial building, which is the property given up, and we have an apartment building, which is the property being received. The purchase date is 10/1 of 2001. The date identified is 6/25 of 2011. So this is the property purchase date on the old property. This is the date we're identifying the new property. Sales price, $900,000. Closing costs at sale, $10,000, and agent's commissions of $54,000. The purchase price at that time was $300,000, and accumulated depreciation is $70,000. Mortgage owed on the old property is $150,000, and the date transferred in the exchange, we have 10/1 of 11. And the date received in the exchange is 10/1 of 2011. So what I've tried to do is to incorporate for you the information under the sale of the old building and the acquisition of the new building that tie together and are related in some way. So if they tie together, they're the same color. And if they're related, they're kind of on the same line but different colors. So obviously we're concerned about how much we're selling the old property for and how much we're paying for the new property, because we don't want to realize any boot because we traded down. We need to be trading up. But we also need to be establishing how much cost we have in the property. And our cost is what we paid for the old property minus any depreciation we've claimed over time, plus any cash we bring to the table to purchase the new property. Those are calculations going in to calculate our cost in the new property. We then have the mortgage owed on the old property and the mortgage taken out on the new property, and we're concerned about these two types of trades here interfering with what we have up here. So we don't want to see these numbers and these numbers canceling each other out somehow. They have to build on each other. So in other words, this side needs to always be more than that side in most cases. Date transferred in the exchange, we've got that they're within the 180 days and within the 45 days as well. So when completing Form 8824, assume the following on this particular transaction. The closing costs for the sale of the commercial building and the purchase of the apartment building will be paid down from cash, down payment, and the new mortgage. And the old mortgage is paid off by the proceeds from the new mortgage. That's the information that we're assuming. So in the green up here, we have information that's used to calculate the adjusted basis of the commercial building. The purchase price is $70,000, accumulated depreciation is $70,000, and that leaves us an adjusted basis of $230,000. We then go on to additional money borrowed. In addition to giving the old property, we had to come up with enough money to buy into the new property. And how much more money did we have to come up with above and beyond the old mortgage that we're trading out on or getting rid of? Well, we have the differences in the mortgage. The old mortgage was $150,000, and the new mortgage is $316,000. So the additional money we're borrowing is $166,000. So $166,000 is the amount of boot we're bringing to the table, but it's not boot we're receiving. And then we have the basis that we're going to have in the new apartment. Well, our basis in the new apartment is going to be our adjusted basis from the old property, plus additional cash paid, plus additional money borrowed. So when we're all said and done, the adjusted basis in the new apartment is going to be $406,000. How do we figure our realized gain? Our realized gain is the sales price on the sale of the old commercial property, $900,000, minus the adjusted basis, minus closing costs, minus any expenses of the sale, such as agent commissions. And that gives us a gain on the sale of $606,000. But we're not going to have to pay tax on $606,000 because we've got a perfect like-kind exchange where we're doing all of the requirements perfectly to avoid boot triggering taxation. So the fair market value on the property Josie is receiving is $1 million plus closing costs that he pays on purchase for fair market value of property received of $1,012,000. And you can see here on this particular one, I say realized gain on the commercial building, that carries to 8824 line 19. That's the number we want to see on line 19. And the basis of the apartment building, 8824 line 18, this is the number that we want to see here. And the fair market value of the property that Josie received, $1,012,000, needs to be on 8824 line 16. So I go over and let's take a look at the form itself all filled out. Page 1, we're identifying the property given up and the property that we're receiving, the date acquired, the date sold, the date identified, the date received. We then move over to page 2, and on page 2, line 16, we begin with the fair market value of the like property that we received. I've copied that same formula from the earlier page over so you can see it again. Then on line 18, we enter exchange expenses not used on line 15. That is these ones here, the adjusted basis of the commercial building plus additional cost paid plus additional money borrowed, adjusted basis of, line 18 is adjusted basis of the like-kind property, and that's 406. Then on line 19, we have a realized gain, 606,000, and I already showed you how we computed that. And what is our basis in the like-kind property received? 406,000. So the gain is 606. The new basis in the new property is 406. The old basis in the old property was 230. So my question to you is, how does depreciation work from this point forward? So earlier, on one of the earlier rules, we talked about what do you do with depreciation now that you've got this new property and we're starting to depreciate it. What are we going to do? So we have the existing basis or the adjusted basis in the old property that has been depreciated. It had an original cost of $300,000, and over time we had depreciated it. But the adjusted basis is $230. What the IRS says is we're going to continue to depreciate that old basis on that old building over using the same maker's convention that was applied on the old building. Now there is a difference here in that the old building was commercial and the new building is an apartment complex, which would be residential. So the commercial would have been depreciated over a period of 39 years, and now it's going to move to 27.5 years. But then we have the additional money brought to the table to purchase the new building, and that's going to start a separate depreciation line, which will be over 27.5 years with a placed in service date that is the same as the date of the like-kind exchange. But the placed in service date on the original cost basis is going to be back when that property was originally required. Okay, so that's the end of the lecture part of today's class. So that is it. Thank you, everyone, for attending. Appreciate having you in our class.
And that concludes the Session 18 lecture. It is now time to move on to the classwork assignment, which begins on page 61 of your Session 18 student manual. This assignment involves preparation of a Form 1040, Schedule A, Schedule B, Schedule D, a 6252, and the Section 1250 and Schedule D worksheets. Our character is Lois Lane. Lois sold her home to Clark Kent for total compensation of $500,000, including assumption of Lois's existing mortgage in the amount of $100,000 and principal payments over 30 years in the amount of $400,000. Lois first bought her home back in 2002 for $130,000. She made the following improvements to her home while she owned it. They include landscaping, a remodeled kitchen, a bathroom, and a new roof. In 2009, Lois claimed business use for home and a depreciation deduction of $1,000. Lois had the following expenses relating to the sale of her home: real estate commissions of $30,000 and closing costs of $2,500. Clark made a down payment of $50,000, and he also assumed Lois's $100,000 mortgage. He will pay her the remaining balance in payments over 30 years. The stated rate of interest is 7.5%. The sale closed on May 31st of 2011, and Clark paid down $50,000. He began making the monthly mortgage payments on July 1st, 2011. Use the attached amortization schedule in Lois's W-2 to prepare her tax return. Lois's W-2 shows she works for the Daily Planet, that her wages were $55,000. She had $12,000 of federal tax withheld and paid taxes to her state in the amount of $6,000. The amortization schedule shows that the first payment was made on July 1st. It shows the principal amount of the loan, the amount of the payment that went towards principal, and of course the difference between the amount of the payment, which is $2,432, and the amount that went to principal is interest. So Lois collected payments in July, August, September, October, November, and December. So you'll need to add up the total amount of principal payments and the total amount of payments do a subtraction to determine the amount of interest that Lois received for the year and the amount of principal payments that Lois received for the year. So at this point, please push pause on video playback to complete Lois Lane's tax return. When you are finished preparing Lois's tax return, please resume video playback for a review of the answer key. And I now have the classwork assignment answer key for session 18 on the screen in front of you. And I'm going to bring you firstly to this paragraph on the very first page. Because, of course, one of the things we need to do for Lois is complete a Form 6252. She does not complete a 4797 the way Diana Prince did. What's the difference between Lois and Diana? Well, Lois sold her personal home. She did not sell a business use asset. Diana Prince sold a business use asset, and therefore the sale of the rental home for Diana was reported on Form 4797. But for Lois, her sale is reportable on Schedule D, and if it's an installment sale, she also reports that sale on Form 6252. Now, for the year of sale, she must complete Part 1, and in Part 1, she's going to enter description items as they belong on each line. And she's also going to need to do some figuring. And one of the things that she needs to enter on 6252 in Part 1 on line 8 is the cost of her home. The cost of her home is the original purchase price plus the improvements that she made over time, and those totaled $172,000. We also need to enter selling expenses on line 11 of the form, and the selling expenses were commissions and closing costs that totaled $32,500. Let's take a look at Lois's Form 6252. And here we have Lois's 6252. We begin on line 1 by entering a description of the property sold. The date acquired and the date sold are entered on line 2. There's a question, was the property sold to a related party? The answer is no. And then in Part 1, we move on and enter the appropriate information. The selling price of the property is $500,000. Clark is assuming a $100,000 loan, and therefore the $100,000 is subtracted from the $500,000, leaving him with amounts payable to Lois of $400,000. The cost basis of the property is $172,000, and Lois previously claimed depreciation in the amount of $1,000. $1,000 reduces her basis in the home from $172 down to $171. Then on line 11, we add back in her selling expenses of $32,500, and we add up those two amounts, $171 plus $32,500, to get her total basis in the house, which is $203,500. We then subtract $203,500 from the sales price of $500,000 to arrive at Lois's gain of $296,500. Now, since Lois is selling her primary residence, she is eligible to claim an exclusion of $250,000. $250,000 of the $296,500 gain is not taxable. That number, $250, is subtracted from the $296, and that leaves Lois with $46,500 of gain that is taxable. She's going to divide $46,500 by the amount from line 6, which is $400,000. And that leaves her with a ratio or a percentage amount, a gross profit percentage of 11.625%. Now, what were the principal payments that Lois received for the year? Let's go figure that out. Principal payments included the $50,000 down payment as well as the principal payments shown on the amortization schedule. And for each month that Lois received a payment, we showed you the amount of the payment that applies to principal. And when we add those up, we get $1,491. $1,491 plus the $50,000 down payment is the total amount of principal payments that Diana received for the year. The other thing that we need to look at is that the total payments received for the year are more than the principal amount. And the difference between what Lois received in payments and the principal amount is interest. So I'll show you that in just a minute. But for now, let's go enter the $51,491 on Form 6252. And here we've entered it on line 21. The next step is to multiply $51,491 by 11.625%. And when we do that, we get $5,986. $5,986 then carries to Diana's Schedule D and is entered on line 11. How much of that gain is for a recovery of depreciation? $1,000 of prior depreciation was claimed on the property. That means Diana will pay a rate of 25% tax on $1,000, and the difference between $1,000 and the total gain of $5,986 is $4,986, and $4,986 will be taxed at a maximum rate of 15%. Let's finish working on Lois's tax return before we move over to the Schedule D worksheet. And let's take a look at Lois's Schedule B. On the Schedule B, we need to enter the name of the person who is making payments to her, and that is Clark Kent. We enter his Social Security number and his address, and the total amount of interest he paid her for the year is $13,101. And the way that we calculated that was to look at the total amount of interest paid. And when we looked at the amortization schedule, you essentially take total payments of $24.32 each month for a total of 6 months. You multiply that out, subtract the principal payments, and you're left with the amount of payment that is interest, $13,101. $13,101 is taxed as ordinary income, and here is Diana's 1040. Her wage income was $7,000. Her taxable interest is $13,101. Her capital gain is $5,986. We total her income up, and on line 37, we have $74,087 of adjusted gross income. Her itemized deductions, the only deduction she had was state income tax withheld on her W-2. That was $6,000. Her exemption deduction is $3,700, and it's time to figure her tax. To figure her tax, we need to do the Schedule D worksheet. And on the Schedule D worksheet, we begin by entering her taxable income. From $64,387 of taxable income, we subtract out the amount of income that is attributable to capital gain. That was $5,986. And we then separate out the $1,000 that is for recovery of depreciation. That leaves $4,986. The next step is to determine how much income Lois has after you subtract out her capital gain. Her income after subtracting capital gain is $58,401. That is more than the base amount for her filing status. That means that all of her capital gain is going to be taxed at a rate of 15%, and none is eligible for the lower 0% rate. We take $4,986, multiply that by 15%, we get $748. Next, we take the $1,000 of recovered depreciation, multiply that by 25%, and we get $250. The next step is to figure all of the remaining tax on Lois's remaining income. That remaining income is $58,401. The tax tables tell us that the tax on that is $10,731. We take $10,731, add $250, add $748, and we get $11,729. The tax tables for all of Lois's income, $64,387, gives us a tax bill of $12,219. Lois is allowed the lesser of line 36 or line 35. She goes for line 35 and enters $11,729 on line 37 and on her Form 1040 on line 44. Lois had $12,000 of federal withholding, and she is left holding a $271 refund. So that concludes the review of Lois's tax return and the Session 18 classwork answer key. Let's take a look at the homework assignment next. Password number 3 is SAREK, S-A-R-E-K, SAREK. And the Session 18 homework assignment is shown beginning on page 63 of your student manual. This assignment involves preparation of Form 1040, Schedule A, Schedule B, Schedule D, E, 4797, a 6252, a Schedule D tax worksheet, and an unrecaptured Section 1250 gain worksheet. So we're combining a little bit of the type of information we covered with Lois Lane and some of the information we looked at with Diana Prince and combining them into a tax return, this time for Lana Lang. Lana Lang lives at 1919 Smallville Way in Smallville, Kansas, and she sold her rental home to Lex Luther. Lex made a down payment of $40,000 at the time of purchase. Lana originally purchased the rental house back in 2002 for $102,000, and at that time the land was worth $22,000. She has not ever lived in the house, and she had the following closing costs on the purchase which have been added to the basis in the property. Title charges other closing costs as well as a tax lien that she paid for the seller in the amount of $600. Over the years, Lana made the following improvements to the property, including a new deck and a new roof. She did not rent out the rental property during the year. It was left vacant to make it easier to sell. Lana's depreciation schedule is shown below, and depreciation is the only expense she had on the rental during the year. Use the depreciation schedule to prepare her Schedule E and as well to prepare her Form 4797 and her Form 6252. Lana incurred the following expenses in relation to the sale of the property. For purposes of calculating gain or loss on the sale of the property, treat the entire sale as a single transaction that is reported in Part 3 of the 4797. We're not going to make you go through all the miserable work you did with Diana Prince. We're going to make it simple this time. No land allocation should be reported in Part 1 of Form 4797 because all gain from the sale is actually being reported on Form 6252. So this one's another mind bender to you or for you. Just do the best job that you can. And at the beginning of Session 19, we will, of course, review the Session 17 quiz answer key, and then we will take a look at the answer key for the homework assignment involving Lana Lang's tax return. So that concludes Session 18 of the Basic Tax course. Thank you for participating, and I will see you next time at the beginning of Session 19. Bye-bye.